is in investing thematically across a global multi-asset portfolio set, which is where I focus my attention. And that's really where the juice is. It's in both the old and the new. Here's the funny thing, and I've written about this. ICLN, the clean energy ETF, is down almost 20% year to date. Okay, it's had a very good correction, healthy in my view. XLE, the oil majors, up 40% year to date. So you can play with the old and the new and participate in markets going forward. I think we have a breadth of activity in the stock market, which is very robust. We've been able to go through bull and bear cycles and not have any problem. That's great.
Just real quick here, Jay, how much is that view contingent on the Fed not hiking rates for the foreseeable future, and that means through 2023?
Well, I don't know about 2023, Lisa, but I don't think the Fed does anything for the rest of this year, all of next year, and then maybe the second half of 2023. Let's see how it plays out. I don't think it's worth spending a lot of time on that, frankly, because it's so far in the future. But I do expect this, push and pull. We are in a bear market for U.S. Treasuries. We're not going back to the levels we saw 6 months ago. Rates are going to be higher. They're going to be significantly higher over this coming cycle, which I think will reflect a better growth profile driven by fiscal and monetary policy working together on a global basis.
Jay, you're welcome. I gave you a moment on European banks. Jay Pilowsky, good to see you. Thank you, sir. TPW Advisory founder and principal. Banks in Europe doing nicely. On the S&P 500, up 25% year to date. You had Jay Pilowsky there, Tom, mentioning the XLE, the energy sector here in the United States, up 41% over the year so far. What a quarter.
I mean, we're Fed focused this week, John, but the arch question is, do you get on board those that have been leading, or with the correction that we've seen in those of the pandemic, do they come and catch up? And, I'm not going to give an opinion, but that's certainly the major debate right now.
Have we already seen the early part of the cycle, Lisa, this quickly in 2, 3, 4, 5 months?
Well, and then there's a question of, if Europe is 9 months behind us, why not go to Europe? Because the ECB is going to keep the pedal to the metal in terms of policy.
That's what I struggle with the European bank story. Is the recovery going to be steep enough to actually lead to higher interest rates to justify what we've seen in the banks trade and be one that can win the cycle, Tom?
Yeah, the European banks, they're part of the pendulum of doom.
They are. They are. Coming up, 8 a.m. Eastern, Noel Coram, Invesco portfolio manager from New York City this morning. Equities all-time highs, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. There hasn't been a major federal tax hike since 1993. Bloomberg's learned that President Biden wants to change that. He'll call for higher taxes to pay for a long-term economic recovery program. That plan would include initiatives on infrastructure, climate, and expanded help for poorer Americans. The president would likely try to repeal portions of Donald Trump's tax law that benefited corporations and wealthy individuals. And Republican members of Congress are headed to the U.S. border with Mexico. They want to put a spotlight on a surge of immigrants at the frontier that they say is a result of President Biden's immigration policies. House Republican leader Kevin McCarthy will lead a dozen other lawmakers on a trip today to a detention center in El Paso. More problems for AstraZeneca's coronavirus vaccine. The Netherlands has joined a list of about a dozen places moving to suspend the shot over concerns about possible side effects. Regulators from Europe to Asia said there is no indication of any direct link between the vaccine and reports of serious blood clotting after inoculation. In Germany, Chancellor Angela Merkel is feeling the wrath of the voters. Her Christian Democratic Union crashed to its worst results since World War II in 2 regional elections. Voters vented their frustration over the government's handling of the pandemic and a slow pace of vaccinations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
expect that face-to-face learning is the ideal, but I don't think that we are ever going quite back to that. What we're seeing is more of this integration of the technology into the day-to-day. We have seen that schools have had this kind of trial by fire in terms of trying to reopen successfully, and that many schools have had to use a system of using different ideas around what it would take to reopen and then pivoting when those ideas did not work well, meaning that some have had to go back and had to close. And that's been a global challenge.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here. Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal time for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Is there a risk of inflation? I think there's a small risk, and I think it's manageable. I don't think it's a significant risk, and if it materializes, we'll certainly monitor for it, but we have tools to address it.
We have tools to address it. Who has the tools? The Treasury or the Fed? Janet Yellen there, U.S. Treasury Secretary, speaking on ABC's This Week over the weekend from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. All-time highs on the S&P, up 9 on the session. We're up 0.2%. On the NASDAQ 100, up 40. We advance a third of 1% there. In the bond market, yields to post-pandemic highs in Friday's session. Right now, around about 162. Basically unchanged on the day. Euro dollar 119.33. Bit of dollar strength against some euro weakness there as we go into the Fed on Wednesday. For those of you that might have been confused about 20 minutes ago over the Techno King, can I just reiterate that this news is real and it comes from Tesla? And they do confirm that Musk retains the position as the CEO and Kirk Horn as the CFO, but they get additional titles, Tom, that Elon Musk will be called the Techno King of Tesla and the CFO will also be called the Master of Coin. I feel like someone's being trolled. I don't know if it's the SEC
us
or someone else or us.
We could get in trouble for this.
But that's some news this morning for you.
And again, folks, they took it from John Farrow, Techno King, dancing in Davos. Let's get right to it with Kevin Cirilli. There's 14 things to talk about, but we're going to do China here because it's in the news, it's beneath the radar, and in a couple days, it's going to be front and center. There's a heritage here that goes back to World War II, Kevin, the deep emotion and symbolism of the Aleutian Islands in Alaska, and of course, the drop down by the Japanese to Pearl Harbor long ago and far away. What is the symbolism of the Secretary of State, the Secretary of Defense heading to Anchorage to meet with the Chinese?
Significant. First and foremost, it's the first meeting between Secretary Blinken as well well as the China counterparts in terms of what the broader strategy will be for the United States in the next 2 to 4 years in the Biden administration. Secondly, it comes at a time in which increasingly lawmakers in both parties on Capitol Hill are raising concerns about China from a domestic supply chain perspective with the semiconductor chip shortage, but also beyond that with the looming Beijing Olympic Games. Republicans are now echoing in unison that the United States ought to boycott those Olympic Games. But then third and finally, and I'm struck by this, especially as the rhetoric goes from a broader decoupling perspective, not just away from China, but towards European allies. So for Secretary Blinken, who has had somewhat a level of not just in changing tone success, but also in attracting European counterparts to get back in cohesion with the United States on a broader China policy, that's also going to be something that I think many geopolitical watchers are going to be looking for.
You have the trade issues. You also have some geopolitical tensions that have been rising around Taiwan. I want to read you this quote. Taiwan is becoming the most dangerous flashpoint in the world for a possible war that involves the United States, China, and probably other major powers. It's according to scholars in a recent CFR article. How much are you hearing from the Biden administration about their approach to this particular issue, especially as China builds up its military capacities?
The Biden administration has not yet publicly addressed in a forceful way what you had just identified, which is in the geopolitical chatter world of the increasing prospects of potential conflict in Taiwan. But most of the lawmakers, especially on the Foreign Services Committee, as well as on the intelligence committees and that sphere of Capitol Hill, definitely point to Taiwan as a potential flashpoint for some type of conflict. You know, I was struck back to when the former Undersecretary of Economic Affairs, Keith Kroc, in the previous administration traveled to Taiwan, and the Communist Party of China actually flew military planes in their airspace as a way to send some type of signal. So this has been definitely a story that has been increasing in awareness for Washington policymakers, but is one that has flown under the radar in terms of the mainstream conversations.
And you know, John, this really raises a point that you had talked about earlier, that Joe Biden's administration, when it comes to China, looks a lot like President Trump's administration previously when it comes to China. And you do wonder whether we're hearing an increasingly hawkish tone or whether just a continuation of what we saw before, with perhaps more participation from allies.
Well, that's the one exception, Lisa, and we should pick up on that, Kevin. The allies, getting the coalition of the willing, to borrow Larry Kudlow's phrase that he used years ago, and nothing really happened. Can Europe come along for this drive this time around?
Well, and it's not even just on China. Did you see Jared Kushner's op-ed in the Wall Street Journal just the other day, on the Middle East? But back to China. Look, I think that's the biggest question mark for Secretary Blinken is on 5G technology, on attracting not just the UK, but also Germany to move away from Huawei, to move away from these other technological companies. And can the U.S. attract investment and invest, rather, in Japan, in other countries in that region, and move away from the Xinjiang province? I still haven't heard the rhetoric from the left on human rights abuses that I've heard as loud as I've heard from the right. I don't know why, but I think that when you have, maybe because they're the minority party right now, but what I will be watching for is whether or not those calls on the Uyghurs abuses in China intensify from the left. If that happens, then suddenly there's zero daylight between Republicans and Democrats in terms of their public discourse on these issues.
Kevin, do they keep those two issues separate, human rights and economic relations, or are they the same issue right now?
It depends on who you ask. I'm not trying to dodge. I think I think for Secretary Blinken, it would be, I think there's no question that the Beijing Games are a bargaining chip, for lack of a better term, in the next 2 to 4 years for U.S.-China relations. But I think in terms of where, I was just speaking with a source actually yesterday, a progressive source, who said, who cares if the United States goes to the Olympics? That would have no teeth. Why not go from an economic approach and really try to hit China where it would hurt them?
It would be hard to believe that a country that has basically accused another country of genocide, Kevin, would also allow those Olympics to go ahead. But maybe that's the position we're in right now.
Yeah, and beyond that, negligence at best, putting it nicely, on the virus.
Kevin, good to catch up. Kevin Cirilli, Chief Washington Correspondent and host of Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern. Look, Tom, it's such a complex issue. And I don't want to make it sound like it's a simple 5-minute conversation, but it's not. It's going to be really difficult to achieve anything on this front.
In the confusion of the Olympics, I believe it's the Winter Olympics, and it's sooner rather than later, John. This is not an issue down the road a la Japan. This is an immediacy with this debate over China.
Just before we go, we mentioned the vaccine push a little bit earlier on this program. I talked about vaccine hesitancy, a lack of acceptance, and maybe widening the pool. Check out Hong Kong. Tomorrow, Tom, 30 years old plus, this will be opened up to because of the hesitancy and the reluctance to get a vaccine in the older age groups.
As I mentioned, a single announcement here where I say pandemic on, pandemic becoming off was that Alaska announcement, and you see that as the age cohorts come down.
Coming up on this program, on the fixed income market, Gene Tenuto, Columbia Threadneedle Investments Global Head of Fixed Income. In your bond market, last week, all over the place on 10-year yields. This morning, 161.96 and unchanged on the session so far. Your high of the pandemic, the post-pandemic high, came in Friday's session, and that high on the 10-year was 164. From New York, this is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Monday, a Bloomberg exclusive conversation. Bank of America Chairman and CEO Brian Moynihan, live at 12:30 p.m. Wall Street time on Bloomberg Television and Radio.
From New York City for our audience worldwide, good morning to you all. Alongside Tom Keene, Lisa Abramovitz, I'm Jonathan Ferro, live on TV and radio. Here's the price action this Monday morning. All-time highs on the S&P 500. We add a little bit of weight to it. On the S&P, up now by about 0.1%. On the NASDAQ, up by 0.2%. On the Russell, we pull back. But on the year, on the Russell, up 19% with a NASDAQ that is basically dead flat. And you know why. It's in the bond market. 2s, 10s, 30s into Wednesday. Does the chairman of the Federal Reserve still see this as a statement of confidence? We saw 164 on Friday. That's a new post-pandemic high on 10s. Your yield right now, 162.31. And unchanged on the session. 30s doing not much too at 238. Interested to see the NASDAQ post a week of gains last week, up 2%, even with that 10-year yield creeping higher by 6 basis points. So we finally started to get a little bit of sense of stabilization there, Tom. That's something we'll talk about through the week. Let me finish on this one, though. Just on Europe, and I think this is the hardest trade to get right now. The story around Europe and the divergence between Europe and the United States is so well known. Is it well priced? Euro dollar year to date comes in 2%. Euro dollar 119.32. But Tom, look at the banks. We talked about this with Jay Pawlowski moments ago. The banks in Europe are up 19.5%, largely off with what we've seen on rates. But when it comes to the economy, does the outlook in Europe justify the gains we've seen in the financials on the continent?
I'd go relative book value there. The book value of J.P. Morgan leading the way, world class, nicely above 1. And the others, including Brian Moynihan at 12 noon today across Bloomberg. And then, John, I'd go to the European banks, which is just totally cratered, 0.33. 0.23 of book value, and that's a different number. I know it's something, John, that Romaine follows.
It's a big repricing here in Europe and a big repricing for the United States as well. Let's get to Romaine right now. Morning, Romaine.
Hey, good morning, John. Welcome back, Tom. And I'll start off with Europe because over in Europe right now, we're seeing all those travel stocks. I didn't know where you were on Friday, Tom, but welcome back. They were nice to me while you were gone. So, I mean, we're talking about travel stocks over in Europe. You saw the Stock 600 Travel and Leisure Index actually reclaim those highs from the pre-pandemic levels. That's actually a pretty encouraging sign. But you take a look at the U.S. travel stocks. Remember, we reclaimed those highs here in the U.S. maybe about 3 or 4 weeks ago. You're seeing that rally continue. So everyone's focused on bond yields, real yields, of course, what the Fed's doing. But the Travel and Leisure Index is really just kind of doing its own thing. MGM Resorts getting an upgrade this morning over at Jefferies, saying that the trajectory of a recovery on Las Vegas casino is going to be a lot steeper than what a lot of folks were expecting. TripAdvisor got a price target upgrade to a street high target on Friday. And then, of course, you had all of that data coming out of the TSA basically saying 1.4 million passengers screened on Friday. That was the highest level in a year. The Jets ETF, which of course tracks all of the airlines across the world here, that's up 2% here in the morning and up about 25% or so just over the last couple of months. Tom, this is a big deal here because this is about us getting back out. Yeah.
You know, I lived this, Romaine, this weekend. I was looking around. Pharaoh's got the Gulf Stream next weekend. And so, Romaine, I was actually out with a riffraff looking at commercial airways, and it's crazy. I mean, it's crazy.
Where did you go? Did you go to the Grammys?
No, I haven't gone anywhere.
Were you nominated this year?
No, I didn't go. I said if Dua Lipa's not going to win pop record, I'm not going. So, but Romaine, seriously here, the airlines are on fire on this, and you see it in the real world we're living in with them on the phone.
Absolutely, and this is a big deal. I could tell you, I mean, a lot of people I know are already booking vacations and other travel for later this year. We've already heard from airline executives on our program saying that they're actually concerned now about capacity later in this year, that basically they're just not going to have enough seats, and I guess that's good for them as far as terms of pricing power, but if you're traveling, that could be an issue. Flip up the board real quick. Just want to show you a couple other things. We're getting another S&P reshuffling here. The biggest addition is going to be NXPI. That's NXP Semiconductors, Penn National, Caesars going in as well. The ones getting knocked out, primarily Flowserve and Xerox. Xerox actually getting the boot from the S&P 500. Yep.
Wow, that's a piece of history right there. Romaine, thank you so much. A headline out, Blackstone, not BlackRock, Blackstone and Starwood to buy extended stay America for $6 billion. That from Dow Jones, maybe the first of a Monday announcement of mergers. This is a joy because it dovetails nicely with our editor-in-chief emeritus, Matt Winkler's great work with Shinpei on all the times we've gotten inflation wrong. Matt Winkler talks about the wise men, They got it wrong year after year, decade after decade. Gene Tenuso joins us with Columbia Threadneedle. He is head of fixed income for them and comes to us with the history and the heritage of Carlton of Minneapolis as well. Gene, why do the wise men get the inflation call wrong? We all know this. They come out, worry, worry, worry. They get it wrong. Let's start with the why. Why have they gotten it wrong?
Well, to some degree, Tom, it's because of the success of monetary policy. I mean, if we think about the mission of monetary policy, it's price stability among several other objectives on the labor market. And if we look at where inflation has been for the last 25 years, 95% of the time, core PCE inflation has been between 1 and 2.5%. So I think for the most part, we've gotten price stability, and we've gotten exactly what central banks wanted, which is low and stable inflation expectations.
Yeah, Gene, it's Monday. We don't go Fibonacci on Monday, but we're going to do a partial Fibonacci here. What part of the yield curve dynamic interests you right now?
Well, look, we were looking at the long end of the yield curve because on Friday, the 30-year hit the exact same yield that it hit on December 31st, 2019, so pre-pandemic by most measures. And so if you look at where we are from a Treasury perspective, we know why the front end is at zero. The Fed has pinned front end interest rates there, and the long end has now fully retraced. So now it's just a fine-tuning question of the intermediate segments of the yield curve, and I think that's really going to depend a lot on how the Fed frames this discussion on Wednesday.
How do you think they will on Wednesday, Gene?
Well, they're coming into this meeting with a different data set. Now, certainly the economy looks better. The spending data look reasonably optimistic. But we also have 74 million more vaccine doses that have been administered in the United States between the last Fed meeting and when they'll sit down this week. So I think the reason to be optimistic is clearly justified. And the question is, do they then reflect that in interest rates? The market is starting to price that in. We actually still think it's a little premature for the Fed to be moving those dots higher.
So you know how the guidebook will work on Wednesday. We'll get those forecasts and we'll look straight to the dots. How big do you think the revisions to the forecast need to be, Gene, this coming Wednesday?
Well, we think growth and employment are going to be pretty large, quite frankly. But what we don't know is the Fed willing to forecast its own average inflation targeting inflation overshoot? Right? So they haven't really done that. They haven't really said, look, we're going to forecast inflation at 2.5%, 3% and keep the policy rate at zero. It'll be interesting to see if they do that.
So going forward right now, what are you looking at in terms of the top performers over the next 12 months in the fixed income space?
Well, look, we think it's hard to generate a real yield above inflation. You certainly can't do it in treasuries or tips. We think there are opportunities to do it in an environment where inflation is picking up, even if it's not a problem, as Janet Yellen said, it's picking up, and we see levered credit doing better in that environment. So you say, boy, high yield, that sounds good, but prices are pretty high. Yields and spreads are pretty low. So what we'd be looking for are those upgrade trades, right? So last year during the pandemic, we saw a tremendous wave of downgrades and fallen angels. That took place in a 2-month period. The upgrade wave plays out over a 2-year period, and that's just starting in our opinion. So I think as the economy reopens, this will continue to gain steam.
So what do you tell clients who say the bond math is bad for us going forward? The best you can do is eke out a positive return, not go gangbusters in an era of rising yields. The question is whether yields will rise quickly or whether they will rise slowly enough to allow you to clip coupons. What do you tell them in terms of how they should be positioned and whether they should just pull their money out of bonds altogether?
Well, I'd say 2 things. The first one is that you do need to be careful. The fact that valuations are elevated is accurate, and that's not unique to the bond market. The other thing that's not unique to the bond market is that discount rates on cash flows in the economy are low and moving higher. That's not just bad for bonds. So we need to be disciplined in our risk management approach when we think about investing in bonds, in dividend-paying stocks, or any other investment in this environment, because if the discount rate's going higher, that's a headwind.
Gene, I want to talk about your expertise long ago and far away in municipal bonds. You were a real leader there. This is ancient history, folks. You've seen this before, a big government pop. What does infrastructure do to the municipal debt market? How does that dynamic work when there's roads, bridges, and all the rest? How does it fold into the tax-free market?
Well, it's pretty significant, and actually we look at municipalities as being the largest investors in infrastructure in the country. So if there's going to be a large-scale infrastructure plan, it really can't happen without the municipal market being involved. So we think it's very critical that this last stage of stimulus focused on getting some capital into municipal governments, but also this next stage that is now beginning to be debated in Washington. Munis are going to play a critical role, and I think it's going to start to expand beyond just the taxable market, where taxable munis have really been a robust market of issuance. I think what we're going to see is more issuance coming back to the tax-exempt market, and with the prospect of higher taxes, I suspect that'll be very well received.
Hey, Gene, looking forward to the conversation in the weeks and months ahead. Gene Tenuso there of Columbia Threadneedle, thank you. Gene just mentioning where will the stimulus go? Where will the checks go? You'll like this research from Dan Dolev over at Mizuho, who surveyed 200 individuals who expect to receive the third round of stimulus checks this week. Where will they go? Around 10% of stimulus checks, according to this survey, may be used to buy Bitcoin and stocks, equating to around $40 billion in total. Now, of course, it's a very small survey relative to how many people who will receive these checks, Tom, but this is part of the conversation of the $1,400 checks. Where does the money go?
Yeah, I think 10%. I mean, it's at the margin. I'm going to call that a marginal amount, John. I'm much more interested in how it is spent in consumption. And, I just don't know. We're going to have to see as we go into this 7 or 8% economy. But the question is on the backside.
How about this? Digital artwork by Beeple set auction records last week. That this was a digital artwork that sold for $69 million. Just talk about the crypto assets broadening to art.
Lisa, that wasn't a stimulus checks.
Lisa, John,
driving a bit into that particular
John has one over his couch.
But we're talking about the amount of money kind of flooding into the markets, and it raises a question of whether these are signs of froth or whether signs of a nascent market growing and becoming more readily accepted.
That's a different trade at the other end of the spectrum, I think.
I'm not saying that Beeple is stimulus checks. I'm just raising the issue of where money is going and going in force, and the digital world is getting a lot of it to the Bitcoin point.
A conversation worth having. Coming up, David Rubenstein, the Carlyle Group co-founder and host of Peer-to-Peer Conversations. What an example. Where are the stimulus checks going? Into $69 million art pieces, apparently. In a bond market,
is it
yields
art?
on a 10-year, 162.83. Is it art?
Is it art?
Are we going to have that conversation right now?
I don't know. Is it art?
Stocks, record highs at 4 points on the S&P, up a little more than a tenth of 1%.
I'll send this to you.
Have you got some art?
No, Lisa's kids do art.
Oh, they do
art
great
too.
art.
Okay.
Living in an art
Beautiful one in New York. Bit cold compared to what we had on Friday.
It is. It's a chill.
How about that weather, John?
How about that weather? This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Bloomberg's learned that President Biden is planning the first major federal tax hike since 1993. The money would help pay for the long-term economic recovery program designed as a follow-up to the pandemic relief bill. That package will include initiatives on infrastructure, climate, and expanded help for poorer Americans. The plan will test the president's ability to attract Republican support and keep Democrats unified. And former President Trump is vowing to punish House Republicans who voted to impeach him by backing primary challengers. But a new congressional map based on the 2020 census may do some of his work for him. 6 of the 10 who voted for impeachment are from states expected to lose congressional seats. Several live so close to their district boundary that they could be moved to another district where they then face another incumbent. Bloomberg has learned that the European Union is preparing to start legal action against the UK in a major escalation of post-Brexit tensions. It follows Britain's decision to delay implementing a part of the Brexit deal relating to Northern Ireland. The move could lead to the UK being hit with financial penalties or tariffs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Because of corruption, many people are leaving the country. That's why I am pushing for snap elections, for snap parliamentary elections, because we do need to have a majority in the parliament which would support the reforms that people are demanding.
There are lots of things we will still want to gather for, but the flexibility and efficiency we can bring from working with technology and allowing people to live their complete lives, I think we will see much more of a hybrid.
We would never have 100% of people sitting here in these offices. We now know that we can be very productive working from home.
If you fast forward and there's a vaccine and people feel comfortable, I think a lot of people will come into the office.
Speaking on peer-to-peer conversations, Emma Walmsley there, the GSK CEO, Kristina Georgieva there, the IMF Managing Director, and Trisha Griffith, the Progressive CEO. From New York City this morning, good morning, alongside Tom Keane, Lisa Bravis, I'm Jonathan Ferro. Here's the price action this Monday. All-time highs that are closed on Friday, 5 points higher this Monday morning, up a little more than 1/10%. 164, the highs of Friday's session on a 10-year yield. Also, the post-pandemic highs on a 10-year. This morning, 162.83 and just starting to creep a little bit higher. And to round things out for you, Tom, in FX, in foreign exchange, the euro weaker by 0.2% against the dollar. Euro dollar 119.28.
Very good. And what's so good here on this March, where we recalibrate on a March 15th, is we recalibrate into what is perceived as an end of the pandemic. You're hearing on radio and television some of these themes, some conflicting, some debate points like inflation, but all of it is about the human condition and what we see here at Bloomberg Surveillance in business. David Rubenstein is with Carlyle Group. His value to us, his peer-to-peer conversations have been wonderful. David, do you perceive an end to the pandemic?
Not overnight, not anytime soon. I do think that if the vaccination program in the United States is as successful as the president hopes it will be, it is likely by the fall we can return to some type of normality. But I don't think it's going to happen overnight, no.
What are business people doing? I mean, you've got great context, not only your daily work with Carlyle, but your earned credibility over the decades. And this is the key question I have, David. Do business people ramp up for a 7 to 8% economy and hope and pray, or do they settle and manage for a 3 or 4% growth rate? Which is it?
I think the business community is assuming we'll have a pretty good growth rate because the stimulus package is obviously going to stimulate the economy. It's a very, very large package for sure. I'd be very surprised if growth is at 3 or 4% given this stimulus. On the other hand, we should recognize that the country has two different business communities. You have the business community of private equity or finance or technology, which is doing quite well, might do better than 4, 5, 6, or 7%. But then you have the underclass, the blue-collar workers, the people who have been laid off, people that don't have enough food and so forth. Those people are not going to be growing at that kind of rate. So we do have two different economies we're really dealing with.
For your company that you are a leader at, how important is it for you to get your employees vaccinated right now?
I think it's very important to have people be vaccinated. Clearly, I think when you have a vaccination process, you're going to have a healthier economy and you're going to have a healthier population. You can't force people to get vaccinated, and I've been disappointed that so many people in the country, relatively speaking, are saying they don't want to be vaccinated. When I say so many, maybe 20, 25% of the population is not yet convinced it needs to be vaccinated. And I think we really can't get complete herd immunity unless we get a very large percentage vaccinated. So I'm disappointed that some people don't want to be vaccinated. I understand why, but I think it's probably the wrong decision.
Well, and this really raises a conundrum for a lot of executives where they want their employees to have the vaccine. They don't know how to encourage it. They can't force them, as you say. What are the best incentives and how important is it for you to get people back to the office, back traveling again, and leading more normal pre-COVID types of lives?
I think employers are struggling with this, but to some extent, I think some employers will say, if you're not vaccinated, don't come into the office. And therefore, some people will continue to work at home, or there will be special places in offices for people that are not vaccinated, but they'll have to be tested when they go in and so forth every day about whether they have the virus. That's not an optimal situation. Clearly, it'd be much better for all employers if their bulk of their employees are willing to be vaccinated. For those who, for a variety of reasons, don't want to be vaccinated, they're going to have to be special ways to handle them. But I don't think you can force people to be vaccinated against their wishes.
Yeah, this definitely has been an issue, Tom. I mean, think about a special place to put people at a time when there is concern about the ongoing spread of a virus that is mutating.
Yeah, that's an interesting idea, and David, this goes back to your public service with President Carter a few years back. How close are we, David Rubenstein, to the common sense idea of a vaccine passport?
Well, I think it's possible, but I don't think that you really are likely to have people being forced to take vaccines, and I just think there's going to be too much resistance to forcing people to be vaccinated. I just don't think that will work. There are many people, and I would say in the minority community, for example, many African Americans have the view that very often they've been used inappropriately for vaccines that maybe weren't as safe as, or other tests that weren't as safe. And therefore, there is some resistance in the minority community, African American community. There's some resistance among white males, many of whom, for political or other reasons, just think that the government shouldn't be telling them what to do. So you do see that white male voters who are Republican, some of them are fairly determined not to be vaccinated. And you can't force them to be vaccinated.
David, what's the pulse of mergers and acquisitions right now, transactions and combinations, not only traditional, but also the effervescence we see in the market with SPACs and such?
Well, for people who are in the M&A world and people in the private equity world and finance world, it's almost as if there wasn't a pandemic, because deals are going on, just people aren't meeting face-to-face by and large. And so it hasn't had a deleterious effect really on this part of the economy. And the SPACs are something that no one could have predicted. They clearly are very effervescent, is the word you maybe have used. At some point, maybe some of them won't work out, but I don't think SPACs are going away. I don't think that SPACs are here just as a temporary measure because of the pandemic. SPACs do serve a purpose. Some cases they do get wildly inflated in terms of the valuations. When you have companies with no revenue getting very high valuations. On the other hand, they do serve a purpose, and I don't think they're going away. They're going to be a permanent part of our financial structure, I think.
David, always great to get you on the program. Come back soon, won't you? Stay close. David Rubenstein there, the Carlyle Group founder. Let's turn to this market briefly. Your equity market turning over just a little bit, unchanged on the S&P 500. Tens now pushing 163. Yields up on a session just a little bit, Tom, in the last couple of minutes.
Well, it's range bound the last day and a half. You mentioned the choppy Friday, but I'm sorry, John, a breakout to a 164 top or even through to 165 would be a huge Monday signal. We're not there yet, but nevertheless, that's clearly the range-bound goal.
We saw 164 in Friday's session, Lisa.
Yeah, we did, and the question is why? What was sort of the impetus for why this was happening then? And here we are. And you talked a little bit about how stocks have managed to eke out gains, not tech stocks, and they continue to underperform. And if you take a look at some of the losses in the likes of Apple, holy cow, 19% down
Unreal.
From the highs?
For some of these tech stocks, yeah, which haven't done a lot since September either. So missed out on that huge rally that we saw in the back end of last year. Then the last couple of months have really struggled in some of these big names. Noel Coram on fixed income joining us shortly, Invesco portfolio manager from New York City this morning. Good morning, 162.83 on tens, all-time highs of the equity market. We add to them just a little bit. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This powerful cocktail of a healthier economy and an economy that's fiscally stimulated.
People are going to be looking forward to spending their money, especially now they have that additional stimulus check.
Many of those checks are going to be going towards people who have a high propensity to consume, and so they're going to spend that money quickly.
We are in a bear market for U.S. Treasuries. We're not going back to the levels we saw 6 months ago.
The focus right now is this unfolding growth surprise, which I don't think we have sort of fully baked into numbers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, a simulcast. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us this morning. Lots going on, and the major theme, John, has got to be a bullish tendency, pandemic coming to an end.
Today's show is brought to you by the numbers 8 and 4. 8% GDP growth quarter on quarter in the fourth quarter. Lisa knows what I'm talking about. 4% unemployment. She's watched way too much of that. Year end, they're the Goldman forecast, Tom, for this year in America. And this year in America is set to be very, very good. If you look at some of these eco forecasts coming through over the last month or so.
And John, one of these things doesn't act like the other things, and that would be the pendulum of doom. I mean, the gloom crew is getting pushed aside, aren't they?
Well, I think we've got to recognize this, that 9 months ago, so many people got this so wrong. And I was part of the conversation too. And you've got to be humble about what's taken place. We've gone from a position of sitting here and saying it will take years, maybe even a decade to recover. And now we're talking about regaining all of it and some in the first few quarters of 21, Tom. And that was unthinkable 9 months ago.
Lisa, half full, half empty. John mentioned Apple at the last hour of our 3-hour simulcast. It's simple. Apple from the top down 16, 17%. Who's counting? Or is it Apple up 114% off the March bottom a year ago?
The question isn't how much, it's what's the trajectory going forward, right? I mean, will those declines continue as benchmark rates continue to rise? Have we already seen this leg of the recovery for big tech priced in, or is there more dynamism behind those names?
Right.
And that, to me, is the big question. Dial this forward. Are we going to see froth popped off the top, and is that going to come in the big tech names despite the fact that they're cash cows?
I want to pause here. I think it's really important, folks, as we look at the gloom out of Europe, Italy, Germany. John knows it better than me. John, the geography of the United Kingdom is really, really something. The decline in deaths there is a triumph. Give us an update. Does the United Kingdom, John, have the same buoyancy we see in America?
The UK is focused on making sure that as many people can get that first shot as possible, Tom, to reduce the most severe cases. And that's why their numbers are 36.2% for the amount of population that have had at least one shot. Are we talking about 7%, 8% GDP growth? We're not. Why? Because we haven't had the same fiscal impulse in quite the same way coming into this year. What we have seen is a massive amount of fiscal support in the downturn, Tom, and that will continue. But this extra $1.9 trillion that we're seeing in the United States is something pretty unique without a comparable situation anywhere that I can see in developed markets worldwide.
Let me do the data here real quick, John. I want you to help me out on bonds. Futures up 4. They were up more earlier. I've got red on the screen on the NASDAQ. The VIX, 21.31 shows that Friday combined into Monday. Good feeling. And I really want to point out Brent crude with a print twice over $70 a barrel, 69.16. John, what is the distinction of the bond market this morning?
Record highs of the equity market, bond yields shifting higher. We've started to see an equity market at a headline level actually start to hit record highs again, even with bond yields still creeping higher. And I do think that's important. But on 10s, 164 on Friday, that was the new post-pandemic high, 163 this morning. Will we get that little bit of a test going into Wednesday, Tom? just that little bit of a test for the Federal Reserve to say, okay, you thought this was a statement of confidence a couple of weeks back. Do you still feel the same way?
Yeah, we're going to have to see on that. Right now, let's get started with a great question. Ben Laidler starting us in, I think it was 2 hours ago, with a real look at the equity market. Now, with Invesco on fixed income and particularly loans, Noelle Coram joins us. And what's wonderful about Noelle is she started out in the trenches of the trading desk as well. And that's really cool. It's very rare that you get academics with her, ability in the classroom that come out of the trenches of trading. What does the loan market look like right now? Invesco's up to their eyeballs in loans. What's the character of the loan market?
Tom, before we get started, I have to tell you that my toddler so perfectly gave me this morning, and I just thought it was too perfect not to show you for St. Patty's Day. So.
Yeah, but it's a St. Patty's Day, which means we have to have a Guinness on tap. Could you get the Guinness?
And for people who are listening on radio, she held up a big sparkly bow tie from her toddler with sequins, just like
Tom's got one of those at home. He just chooses not to wear it in the office.
Yes.
Carry on, Noelle.
Yes. So
how about those loans?
So let me give you our backdrop of kind of growth. We're just below Goldman, I would say. We're expecting around 7% growth for the year. Inflation, we expect to be messy. And that's ultimately going to keep the Fed on the sidelines. We do expect, as inflation is messy, we could see some more rates volatility. And we could see, as a result, loans demand, and you've already seen that. You've seen the retail investors step in a significant way. I would, caveat that the retail investor also steps out, when they start to get worried pretty quickly. So just, of course, we never suggest putting all your eggs in one basket. Diversify where you can, especially with levels where they are, in terms of valuations. Diversify across bond asset classes.
Noelle, this is really important. Typically, when we talk about fixed income, we don't talk about retail participation. What is that incremental retail participation in leveraged loans like? What does that look like in the last month or so?
It's really stepped up because, a lot of investors are worried about that rates volatility. We haven't seen it, though. We haven't seen the volatility carry through into the other asset classes, though. And that's kind of, the main reason that we're still bullish on credit. I wouldn't say we're over our skis in risks here, but we do think that growth is going to be supported for fundamentals this year. And that is ultimately why, we would suggest investing in bonds. We think the growth is going to support companies throughout the year, and that's really what's going to, be the story in 2021.
Noelle, I want to pick up on one of your lines, and it's without context. You can give us that in just a moment, but it's something I've read a million times in fixed income, and I've read it over the last month. I've read it 6 months ago, 9 months ago, and over the last several years too. Valuations are rich, thus investors are not getting paid for this risk. Is that just the story in fixed income? Is that the new normal, that valuations will always be rich and investors will not be getting compensated for risk because we live in a new world now?
So it is a new world. We are, at very rich levels. And we do think a lot of this year will be about clipping the coupon. But because of the volatility that we are likely to see in stocks or rates, it does make sense to diversify your portfolio. So of course, we're actually seeing a lot of crossover investors and a lot of crossover demand come into high yield EM to pick up the yield there and diversify their portfolios there, and then compensate themselves. We still think there's some value specifically within the services sectors that you can also pick up. And there's still a little bit of value in leveraged loans relative to high yield and, of course, IG.
Taking a step back, there's a larger question going forward about whether the Fed has put a floor under the default rate. In other words, is the Fed put basically going to prevent the default rate among corporate debt from getting too high, because they will sweep in and they will end up buying that debt and reducing borrowing costs enough to let these companies continue to survive?
This year, it's really about growth, right? And, we expect defaults to come down. In IG, we expect lower supply. It's going to be a lot about deleveraging. So a lot of companies are making the right moves that we would expect in a high growth year. We would, expect most of the growth to come in the next couple quarters as the stimulus is spent, of course. And then, in Q4, we would start to look for any kind of creeping back of COVID concerns. But ultimately, we expect to end the year at potential in terms of growth.
So if credit risk isn't the main risk here, are you delving also into the riskiest of corporate debt, the CCC rated stuff, even on the fixed side, even on the bond side?
A little bit. I'd say because valuations are where they are, that and if you see continued volatility and you're not being compensated as much as you'd like it as an investor with rich valuations, it doesn't make sense, of course, to go over your skis on risk and take a bunch of risk in your portfolio, but it does make sense to reach incrementally into these higher risk areas because we do expect growth to support these companies and allow them to improve their fundamentals on the year.
Noel, good to see you, as always, and love the bow tie. Noel Coram there.
Can I just say,
Portfolio
John,
manager. Wasn't that great?
You started out the program talking about a Sesame Street reference.
I did, yeah.
We ended up, first of all, do they watch Sesame Street in the UK? Did you grow up watching it?
We watch Sesame Street
Really?
in the UK. Yeah, sure.
Okay, and we got that, and then
so
we got the bow tie.
Tottenham this weekend, obviously.
Carry on.
Thank you. Can I carry on? It's interesting to hear Noel talk about 6-7% GDP growth, and it still sounds like it's consensus, and it's not. It's still not consensus. In the survey that we do here at Bloomberg, the median estimate is still 5.5%. So this whole 6.5%, 7%, 8%, this story, Tom, that's still not quite consensus. It just sounds like it is because so many of the guests that come on this program are on this because they are upgrading their forecasts. We're just not there yet at the median level.
And even more so, John, is the idea of how many people will become unemployed, and the 7 million statistics out there, but again, it's not consensus. It's
but I think that just, Tom, your point there is a really important one. It underlines for how long the Federal Reserve will be willing to stick with this, Lisa. But that delicate dance they've got to take on Wednesday, I think is tremendously difficult, given the size of the upward revisions we're about to see to growth, downward revisions to unemployment. Where does inflation sit, and where does the dot plot sit after that?
And basically, if you look at market indications, people are pricing in that they're not going to say they're going to raise rates anytime soon, but they're also pricing in that they will have to do so. But they expect that at the time that they actually have to do so, growth and inflation will be such that it will be more readily accepted by markets. A tightrope, John.
Can I do a shout out, guys?
Please.
Sure, yeah.
The Grammys are the only awards where they actually really pay attention to people beneath the headlines. I mean, on TV here, we'll run the video, and on radio, all the songs. But in the alternative area, it is so cool that Fiona Apple won Best Alternative Album. I saw her, at the absolute beginning, 1,000,000 years ago, and she took out Tame Impala. Just to give you an idea, John, Kevin Parker of Tame Impala lost everything he owns in the fires in Malibu a year ago. And these people are still out there doing it.
Very cool, Tom.
It's very cool.
Very cool. The musician in you speaking just a little bit there.
I know. And Dua Lipa won and Taylor won deservedly.
Wow. This is what he did last night.
It's just, it brings a tear to your eye.
We're just hearing a stream of consciousness.
I'm surprised you didn't mention Beyonce.
No, I didn't mention Beyonce. She gets all the she deserves it. She's huge.
Good. I'm going to do the tease now, okay?
Beyonce's
you
killing
sure you're
it.
done? You're done on this particular part?
Probably not.
Coming up, Albert Coe, Yale School of Medicine Department Chair and Professor
Slow Rush, Tame
of
Impala.
Epidemiology and Medicine. Equity futures unchanged now. Yields creeping higher. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. There hasn't been a major federal tax hike since 1993. Bloomberg's learned that President Biden wants to change that. He'll call for higher taxes to pay for a long-term economic recovery program. That plan would include initiatives on infrastructure, climate, and expanded help for poorer Americans. The president would likely try to repeal portions of Donald Trump's tax law that benefited corporations and wealthy individuals. Republican members of Congress are headed to the U.S. border with Mexico. They want to put a spotlight on a surge of immigrants at the frontier that they say is a result of President Biden's immigration policies. House Republican leader Kevin McCarthy will lead a dozen other lawmakers on a trip today to a detention center in El Paso. In Germany, Chancellor Angela Merkel is feeling the wrath of the voters. Her Christian Democratic Union crashed to its worst results since World War II in 2 regional elections. Voters wanted their frustration over the government's handling of the pandemic and the slow pace of vaccinations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
It has been very recently when we reached a more clear gender balance internally. So first of all, we need to make culture change, and this is not very, very easy. So we need to do it on a continuous basis.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It's going to make a difference in the lives of millions of people in very concrete, specific ways. This legislation, that everybody's already mentioned, will provide $1,400 in direct payments.
And the checks are going out right now from New York City for our audience worldwide. Good morning to you all. Alongside Tom Keene and Lisa Bramvitz, I'm Jonathan Ferro. Your equity market turning just a little bit negative in the last couple of minutes. We're down about a point now on the S&P 500, pulling back just a touch from record highs. In the bond market, yields up marginally to 162.83. Dollar stronger, crude lower. WTI down to $65 a barrel and off by about 0.9%, Tom.
Yeah, it's off. You know, it's a churn of the market, John. Again, we've pulled back here. I get that, but I just think it's going to be really, you know, data weighted to get to Wednesday in the Fed meeting, and all of that. The backdrop is our thoughts on this pandemic. We've tried with every interview, going back well over a year now, to get clarity, and we do that with Albert Coe of Yale, their School of Medicine Department Chair with Epidemiology and Medicine. Dr. Coe, thank you so much for the update. Give us a variant update. I get mixed articles, mixed messages. Should we fear the variants?
So thank you very much, Tom, for having me back on again. So with respect to variants, yes, we should fear the variants. What we've learned over the last several months is that these variants can be more transmissible, and they can be also more virulent. They can cause increased risk of hospitalizations and deaths. So that's important. So the question is that, you know, what is that threat, specifically here in the United States? So we know now that we have widespread transmission of the B.1.1.7 variant. That's the UK variant. And that certainly is more transmissible, and it's also now increasing evidence that it may be more virulent.
Will these vaccines protect us against that? As you sit there, the expert in New Haven, do you suggest we're all becoming a little too enthused?
Yeah, so certainly the good news is the rollout of vaccinations, and I'm particularly proud as a citizen of Connecticut that, you know, our state's doing a great job in getting almost 30% of its population vaccinated. The big question is the one that you've just asked, Tom, is that are we going to have what we call vaccine escape variants or mutants? And, we have some inkling that that may be the case in South Africa with the variant that has arisen there. We're also worried about that with the variant in Brazil, which is causing a humanitarian crisis there in that country. So there's going to be more to come. But I think the bottom line is that you can only get mutations if the variants replicate. And the best way to prevent them from replicating is to prevent transmission and controlling transmission, whether it's through public health prevention or whether it's through vaccines.
All right, preventing transmission, that's exactly where I wanted to go. In particular, how it had to do with AstraZeneca's vaccine and the idea that you have an increasing number of European nations raising concerns about the incidences of clotting after the injection. What's your take on the evidence here? Do you think that there has been enough evidence to show that perhaps there should be a pause put on the AstraZeneca distribution?
So I think it's important to note, Lisa, that several European EU countries have suspended the use or temporarily halted the use because of these concerns on blood clots. But they also acknowledge that there is not enough evidence to show that there's a causal relationship between receiving those vaccines and those blood clots. I think it's important to remember that, in the general population, blood clots happen once or twice for each year for every 1,000 people. And there have been tens of millions of people vaccinated with the AstraZeneca vaccine. So certainly the 40 cases that they've identified could be just the background rates that we see in the population. So at least in my personal opinion, we haven't seen any smoking guns or anything that shows that these vaccines are other than being safe as well as being effective.
Doctor, is it what you would expect early on in the vaccination process in Europe to see these kinds of incidents happen, given who we are vaccinating first?
Most vaccination programs have been particularly focused on targeting the elderly who have, and people with underlying medical conditions have higher risk of poor outcomes from COVID in order to protect those populations. Those are also the populations that also have increased complications, just baseline complications due to the underlying medical conditions. So again, those rates that we're seeing, these are 30 cases among 5, 10, over millions of people that have been vaccinated. So these are very low. And again, these may not be a causal association between the vaccine and these very rare events.
Dr. Ko, there is a larger question here, though, of whether there is a huge difference between the different vaccines available. In other words, a lot of health officials have tried to prevent vaccine shopping, but is there a material benefit to certain vaccines over others?
So from the public health point of view, I think the first objective or first goal of a vaccine is to protect people from dying from the disease or having the severe complications. And all the vaccines that have been approved in the EU and the United States and WHO, have shown that those vaccines are highly efficacious. There may be some differences between whether they protect against milder forms of the disease or infection. That's information or that's evidence that we still need to get as these vaccines are being rolled out. But those are really small, probably minor or less important differences. I think the big issue is that the key issue in getting out vaccines is the accessibility and the ease of implementation. And, I think one of the big game changers has been the J&J vaccine. To give a vaccine that's one dose, you can imagine, and doesn't require complex cold storage, in very low temperature freezers.
Yeah.
That's a big lift all around for many segments of the world's population.
It's a game changer, all right. Albert, great to catch up. Professor Albert Ko there of the Yale School of Medicine from New York this morning. Good morning to you all. As we take a look at the market just quickly to give you a feel of things this Monday as you wake up. We pull back just a little bit on the S&P 500, down a single point there as yields are unchanged in and around, Tom, 162 on a 10-year maturity.
John, I don't agree with that. Yields are unchanged range right now in the churn, the day-to-day tick.
So we agree on
yields
that.
Are stunningly moved from weeks ago. I mean, Chairman Powell has a whole new yield world on Wednesday to look at.
I agree, Tom. A 164 print in Friday's session.
Kumbaya.
162 this morning. We do agree on this, Tom.
We do agree
Unchanged
on this.
now.
Okay.
Changed lots over the last month.
Okay.
A lot for them to think about on Wednesday. Looking forward to the special. How many hours you run for on Wednesday?
I don't know. It's like 3. I don't know. I can't keep count, you know.
That'll be fun.
What are the special numbers?
Hopefully I'll have a
that
green
number will be
sparkle
brought
bow
to you
tie.
by 6.
I'm going to have a green sparkle bow tie. Investors nailing it in.
Alongside Tom Keene and Lisa Bramvitz, I'm Jonathan Ferro. Your equity market's shaping up as follows then. All-time highs at the close on Friday. We pull back by a single point this Monday
Should we play
morning.
Tame Impala? I don't know.
You can pick a song from the artist I've never heard of. I'd love to hear it. You got one?
Oh, no, Borderline. Quite a loner, you know, quite a show for a
I'll get on
loner in LA.
Spotify. Right on it. All right.
Thank you, Borderline. Thank you.
We will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramovich. I'm Jonathan Ferro. Counting you down to a Fed decision this Wednesday, going into that equity futures pullback from all-time highs. Just a little bit on the S&P 500. We've got some economic data for you. It means only one thing. Here's Mike McKee.
Good morning, John, and good news to start the week. If you're a bull for the economy, the New York Fed's Empire Manufacturing Index comes in at 17.4. That is better than last month's 12.1 and better than the forecast 15. As a matter of fact, it's the best since late 2018. So we're seeing some strength in manufacturing in the New York area. Here's the interesting thing about it. While the index for employment fell a little bit, still positive at 9.3. The index for prices paid is at 64.4, and that is the highest since August of 2008, just before, obviously, the great financial crisis got underway in earnest. So the Fed has something to look at here in terms of prices. It's not so much, I guess, that New York prices are really high. It's the speed with which they have gone up and whether that concerns the markets.
That's right where I wanted to go, Mike McKee, and I want to do the market here with you because we got Lou Alexander coming up in the bigger view as well. It is the rate of change. It is the second derivative as well. Describe your feel for the first and second derivatives of this boom economy right now.
Well, in the inflation stance, we're going to see a very quick second derivative move because we start to see the low numbers from last year during the pandemic fall out.
But those are artifacts, right?
Fed's anticipating that, and so the real question is, do we see transmission into the core rates from the headline rates? Do we see core rates go up? Do we see inflation start to get embedded in the economy? Or are these one-offs? And the Fed's betting these are going to be one-offs. Prices received numbers still high, but not as high in the Empire survey as the prices paid numbers, the input prices, commodities.
So, Mike, can you walk us ahead to Wednesday's press conference with Jerome Powell? How is he going to walk this line between upgrading their forecasts for U.S. growth, which is basically what everyone is expecting and hoping that they do, while also saying it is still worthy of our remaining easy on the monetary policy front?
Well, that's basically going to be the argument. They'll talk about the fact that we have such a high unemployment rate still, and of course the augmented unemployment rate that he talks about, 10 to 12 million people still out of work, and that the Fed is focused on that. The disconnect so far for the Fed seems to be that the market isn't necessarily buying the change in their format, in their framework, and they're pricing in a move more quickly than the Fed is at this point. Although, to be fair, the Fed only does this quarterly, and Wall Street analysts do this daily. So we will get new projections from the Fed on Wednesday, and we'll see if they move things up. Everybody's going to be looking at the dot plot.
John Farrow, do you see how Lisa Abramovich sort of posits her question to Mike, like, Mike, ask the chairman my question in the press conference?
The issue is
you see the devious way
you know what the issue is now over at the news conference of the Fed, that Mike McKee doesn't get to go first, second, third, fourth, or fifth anymore. He goes somewhere near the end.
What did you have for lunch, Mr. Chairman?
What is the number one question for you, Mike, given that there'll be 20 before you on Wednesday?
I don't know. Tom may have a good idea with the what's for lunch. We'll have to see how it forecasts. It's like the White House press room now, where they can't let everybody in, and so they say, "Can I ask a question for somebody else?" So I'll ask a question for Lisa.
Very good. Michael McKee, an eventful week here, and of course, Bank of England. Lisa, did you? I think he was taking notes as you asked that question. So
always. I'm much more direct. He sits right across from me.
The joy of Bloomberg surveillance, folks, on radio, on television, is to move from Michael McKee in the trenches of looking at market economics to someone like Louis Alexander. He's at Nomura, their chief U.S. economist, but that barely describes his contribution, his service at the Federal Reserve System, and particularly his economics. As you know, there's different groups of economists, and Lou Alexander, always since I have known him, has been someone who said, calm down about the worry of inflation. Dr. Alexander joins us this morning. It must have been in the air at Yale University, Lou Alexander. How do you respond to the inflationistas of 2021?
So look, clearly the economy is going to be very strong in the near term, but I would emphasize a lot of that as a burst of growth. So we're going to transition from fiscal support to fiscal drag very quickly. Yes, there are supply constraints at this point that may well drive up inflation in the short run, but I would ask you, are those supply constraints going to be there a year from now? If this is all a temporary burst in inflation, and we think inflation continues to be well anchored, which we do, then I think the Fed is quite right to be sort of relaxed about where it's going to be a year from now.
When you look at the inflation basket, Lou, and the biggest weightings in it, and I'm sorry to interrupt, what do you see as the biggest anchor in that basket for the year ahead?
So one of the things I think people are not paying enough attention to is rent. It's a very big part of it. There are lots of good reasons why it's cyclically sensitive, and it takes time for those things to be worked in. One of the reasons we're not more concerned about inflation in the short run is that. There are some issues around healthcare as well. Obviously, there are policy-related issues there that could drive things up in the short run. But I think, again, we're not expecting that to be something that's going to drive it over the long run.
What about the frictions that people talk about with the increasing and sudden demand for services and all of these companies that have gone out of business and suddenly have to hire workers? People talk about how there could be an increase in wages that perhaps is a bit beyond what people expected at the same time as you have supply chain disruptions with this onset of increased demand. How much does that factor into the equation? Because once wages go up, they're not going to go back down that quickly.
So let me push back on that a little bit in this sense. We've had hot economies before. If you recall what the economy was like for the 2 years before COVID, we were operating beyond full employment with an unemployment rate that was around 3.5%. Aggregate demand was supported by the Trump tax cuts. We were having, in some sense, supply disruptions around trade and immigration. And yet, what were we worried about? We were worried about inflation being too low. Look, the notion that we're going to have the kind of momentum in the inflation process that we had in the 70s, I just don't see the case for that. So is there going to be short-run pushing up of inflation because of how strong the economy is going to be over the next 6 to 12 months? That certainly could be the case. We tend to think there's going to be an offset from rent, but that's certainly possible. But unless you think that's going to be built into the momentum of inflation, then I don't think it's really changed the outlook all that much. Remember, the Fed wants higher inflation.
Right.
And like going from where we are now up to the low twos, which is what they want, I think is plausible, but it's not the sort of thing that's going to raise the alarm bells that the market seems to be worried about.
Okay, so if the inflationistas are wrong, and that's not the tail risk here for markets, let's turn to another issue and something that it has a very controversial profile in markets, and that is taxes. And this comes as Joe Biden talks about increasing taxes the most since 1993, or at least that's what he's expected to talk about to finance his infrastructure plan. What is the track record in terms of how that affects the economy and corporate growth based on history?
So tax increases can certainly be a drag on growth. There's no question about it. It obviously depends on how much and the particular types of tax increases that have been put in place. I would stress the fact that what's being discussed by Biden is pretty moderate. We're talking about taking the corporate tax rate from 21% to 28%, which is sort of where it had been proposed to be before the big Trump tax cuts. To be perfectly frank, you're not talking about paying for even the majority of the infrastructure plan that Biden is talking about. If we get $1 trillion over 10 years in tax increases, I think that's about the limit that one could imagine. I suspect what you're going to see in the negotiations over this deal is as the objections to taxes arise, as the pushback comes, you're going to end up with a somewhat smaller infrastructure bill with somewhat less taxes. So our forecast is we get $2 trillion infrastructure deal with no taxes in it.
Well, Alexander, I want to go back to the inflationistas, and I want to take it back to Tobin and Mead, two of our heroes of another time in place, where James Tobin talked about nominal GDP targeting, of looking at the sum total of the American economy. Are we going back to some form of nominal GDP targeting when we get beyond this pandemic and beyond this constructed boom?
Well, the Fed thought about all of that in their review. Bernanke had a variety of proposals that have been floated that were close to nominal income targeting, weren't exactly that. The Fed has sort of decided on this average inflation targeting framework. So I don't think we're going to move away from that. But I think you can argue that this average inflation targeting has some important similarities to nominal income targeting. Look, the bottom line is, I think they're going to be patient over the next several years. unless you think inflation is about to accelerate in a way that is different from the dynamics we've seen in inflation over the last 20 years, then I think that patience is going to play out.
Lou, always good to hear from you, sir. Thank you. Lewis Alexander there, the Nomura chief US economist. Tom, just to turn to the bond market quickly, 10's 162. Forecast from JP Morgan, new one, 10-year Treasury forecast, 195 from 165 by the end of 2021. And just another taste of how much things are changing and how quickly they are for this market. We're seeing the upward revisions to growth and to yield forecast too.
And that's the one of it as well, that x-axis going out. John, I think that's so refreshing to hear from Dr. Alexander. All the inflationistas, they get all the headlines, John. They get all the media frenzy, particularly the weekend, the gloom and doom, the pendulum of doom report, and all that. It's guys like Lou Alexander that have been absolutely dead on for well over 10 years.
The inflation basket, Tom, and where the weightings come from. It's important
They never got
keep
enough
that in
credit for nailing these calls.
At least it's got to get a final word in on the pendulum of doom, so to speak.
Well, I actually think that the bigger risk is not higher inflation. It's a disinflationary environment. I know this sounds crazy at a time when people are talking about higher inflation, but if you think about where the prices are increasing, it's the stuff we buy. That isn't necessarily a recipe for good inflation unless you get the commensurate wage increases. And unless there's a real boom in services, that to me, John, is really the key question.
I just needed a final dose of it before I went. That's all.
Was that good? Do you feel like that was?
Look,
I want to say something about this, okay? And it's the looking around corners aspect. Well, no, but hold on a second. I would argue that right now it is harder to look around corners than ever because of the bifurcated nature of the outcomes and the risks right now in the market.
It's just so profound. Lisa, thank you.
Anytime.
Coming up on the Open, Steve Major, HSBC
John,
Global Head of Fixed Income Research. You can come. That'll be shortly. From New York City this morning, good morning. Alongside Tom Keane and Lisa Bramwitz, I'm Jonathan Ferro. Honestly, futures down a single point. Yields 160, 125.
Major may not show up. West Ham lost.
That's true. That's true. Maybe he'll be there. Maybe he won't. I will be, though. And maybe Lisa will be too.
Yeah.
Just there to tell you about looking around corners. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Bloomberg's learned that President Biden is planning the first major federal tax hike since 1993. The money would help pay for the long-term economic recovery program designed as a follow-up to the pandemic relief bill. That package will include initiatives on infrastructure, climate, and expanded help for poorer Americans. The plan will test the president's ability to attract Republican support and keep Democrats unified. Former President Trump is vowing to punish House Republicans who voted to impeach him by backing primary challengers, but a new congressional map based on the 2020 census may do some of his work for him. 6 of the 10 who voted for impeachment are from states expected to lose congressional seats. Several live so close to their district boundary that they could be moved to another district where they'd face another incumbent. Bloomberg has learned that the European Union is preparing to start legal action against the UK in a major escalation of those post-Brexit tensions. It follows Britain's decision to delay implementing a part of the Brexit deal relating to Northern Ireland. The move could lead to the UK being hit with financial penalties or tariffs. Blackstone Group and Starwood Capital are betting the hotel industry will recover. They've agreed to buy Extended Stay America, an operator of hotels and motels, for about $6 billion. That represents a 15% premium over Extended Stay's closing price on Friday. Shares jumped as much as 36% in early trading before being halted. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Bold vision around the aspiration to be the most inclusive, the most diverse tech company in the world is what we carry. And these representation goals around half of the workforce being women are the bold vision that we ladder up to.
Has been the laggard. It's been late to the party. And really in the last 3 or 4 months, we're starting to see an escalation in activity. We can't expect New York to rebound until people feel safe, and that looks faster than originally expected.
Jonathan Miller, on top of what's happening in New York, I would suggest from where I observed, yes, there's a new activity in New York City, but it's with reduced rents and a lot of free months to get people induced as we move forward into 2021. One of the great secrets through the weekend is Lisa Bramowitz cooking up a storm, and I'm trying to keep up with her. I do that by looking at Martha Stewart and Tom Colicchio videos from 14 years ago. Colicchio saving me this weekend with the important Cornish hen recipe. Tom Colicchio joins us now from Crafted Hospitality and, of course, one of the nation's leaders on food. What is the comeback of restaurants, Tom Colicchio? We're 1 year on. Can you celebrate now?
Well, restaurants should be celebrating that the Restaurants Act was included in the stimulus package. And so we're receiving, as an industry, $28.6 billion, and that is really focused on the smaller independent restaurants. So that's definitely something to celebrate about. I'm finding that the tone in the restaurant, we've been open at a limited capacity for, a few months now. We opened during the summer, and now we're up to 35%. New York's going to 50% this week. But I've noticed that the tone has changed. People seem a little happier. There's a little more buoyancy. People are still being vigilant in terms of we are, at least in terms of protecting our staff. So we're insisting that people put their masks back on when staff approach the tables, and people are complying. But I get a sense of optimism. It's just, again, it's a tone in the dining room that it's hard to explain, but it's just more chatter, more smiles. Yeah, that's what I'm seeing.
Yeah, and I would say that if anyone who walked around the city yesterday certainly felt the same. There is a longer-term question about how the decline in the office scene, the idea that more people are expecting the office worker crowd to not come back in the same form that it was in 2019. How will that affect the restaurant scene, given the dependence on those business lunches?
It's definitely going to affect it, but I don't know how I don't know if that's going to be long-lived. I mean, David Solomon last week said he wants his workers back in the office. If Goldman Sachs workers go back, I'm sure Morgan Stanley workers are going back, and the rest. And so I expect that after a certain point, people are going to come back. It could be 3 days on, 2 days off. I know that a large company is starting to shed office space, so I'm expecting to see a little less density, especially in Midtown. But I suspect it will be short-lived. I think, after the recession of 2008, it took us till 2015, 13 to start to get really strong. By 15, we were back to pre-recession levels. And I think it's going to happen sooner. I actually expect by December, and this is, again, if these variants are under control, people are vaccinated, I think we're going to have one heck of a December. There's a lot of pent-up demand, a lot of pent-up money, both on the consumer side and on the business side. And I think that money is going to be spent pretty freely. So I suspect we'll have a great December.
So when you talk about the great December, you also have mentioned that you have seen an increasing number of new restaurants pop up. Can you talk about the nature of those restaurants and why they're starting now?
Well, listen, there were some restaurants that were planned to open before the pandemic hit, and some of them just put everything on hold. And so now we're starting to see them open up again. The other thing out there is there's a lot of opportunities out there. A lot of restaurants, as we know, closed, and that's really unfortunate. But the brokers are really busy pushing spaces. And so people are picking up pretty good deals. They're getting built out restaurants with no key money, maybe free rent for a period of time. I don't necessarily see the rents coming down too much, but I'm seeing an extended period of free rent and very generous TIs. Again, if you can pick up a fully built out kitchen, meaning, you may want to do some cosmetic work, but the mechanicals are intact and you're not getting charged for that, there's some opportunities. Unfortunately, it's someone's mishap that's creating those opportunities. So I suspect we'll continue to see restaurants opening up.
Tom, in your video with Martha, what brought me to tears is when you took the 3-ounce baguette in 1/2-inch chunks and then you poured the chicken stock into it to get the stuffing going and for the Cornish hen. We're all having fun pretending we're you at home.
Maybe
are we
you
really going to go back to restaurants?
I'm chuckling here because I have no recollection of doing that with her at all.
He's making it up
4 times. I had my dogs watching.
Yeah, of course. Great. But the question is, are we going to see people going back to restaurants? I think so. Listen, I'm cooking breakfast, lunch, and dinner. I've been doing that at home for almost a year now. I'm getting tired of my food. So I suspect that people are going to want to go out. As soon as people feel it's safe to go out, they're going to go out. Over the weekend, I went to visit my mother. She lives, right now I'm living way out in Long Island, but so she lives a good hour away. I have not seen my mother since it's been over a year, and her grandchildren haven't seen her. And so she's vaccinated now, fully vaccinated. And so as soon as she was fully vaccinated, we waited 2 weeks and then we knew we were safe. And I think that's going to happen more and more. And I think people are going to start feeling, as they're fully vaccinated, they're going to feel really safe to go out. And so, listen, by May 1st, they're opening up vaccinations to everyone. I suspect by, again, June, July, people are going to feel really comfortable. And again, after September, after the kids are back to school, we get past the holidays in September. I suspect October, November, December, Q4 is going to be really strong.
Tom, thank you so much. That's a wonderful way to end our conversation with that discussion of the kind of greetings we're all seeing here over 1 year on. Mr. Colicchio, of course, with Crafted Hospitality, and I would note Craft LA opening this week. Lisa, you sit there and it is those stories, and what it's really about to me, Lisa, is the pent-up emotion for every family. Every story out there, the single people, the married people, and all that, even the divorced people, Lisa. I mean, it's just extraordinary, the pent-up emotion to get out there back to normal.
I would totally agree. I also am so excited, my pent-up emotion to be able to tell my children, even Tom Colicchio is sick of his own cooking. So you can't complain about mine anymore because you know what? Everybody is sick of it. But I think that what he's speaking to is right. Everybody does want to get out. And that is really the question of this boom and the nature of it. If everybody has the savings that they can then go out and spend, good luck reserving your plane tickets like you found this weekend.
Yeah, the plane tickets is what I'm looking at. But also, I wonder what portion of the 7 million employed this year are in Mr. Colicchio's world, and I would suggest it's a larger amount than we think.
Yeah, and how many people will come back? I just do want to note that Goldman Sachs upgraded their forecast, and they now are expecting U.S. growth to accelerate substantially to as much as 8% in the fourth quarter of this year versus the same period in 2020 annualized, and for the unemployment rate to fall to 4% by the end of this year.
That's the key number to me.
4%.
And then what does that do to wages?
Correct.
As we talked to Lou Alexander about. And I'm really not looking at this Fed meeting. I'm fascinated about April 28th.
Yeah, and the question also is, are people getting brought back into the market that weren't previously in, that haven't been counted? I mean, how this number is calculated will also be important to watch, Tom.
Oh, Lisa, we didn't mention Bitcoin today.
I think we mentioned digital art. Isn't that close?
We did mention that's close.
But
yeah,
Bitcoin, yeah, surging back up past 60,000
down to 56,000 over the last
Didn't you
number.
take the weekend off to invest in Bitcoin?
I did, yes.
Yeah, how'd that go?
No, I'm still in the triple leverage all cash fund.
Oh, an entry point.
Important discussion on banking, American banking. Brian Moynihan, Bank of America. Look for that in the 12 o'clock hour. David Weston with that conversation. This is Bloomberg.
We will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
central bankers are generally holding.
The market is stuck between two narratives.
We've had already a big backup in yield.
Treasury yield is going up.
The sort of bond market and the tantrum.
It's a sign that the economic backdrop is improving.
The Fed's been very clear.
Core PCE over 2% for a multi-month period.
They want inflation to run hot.
No question there's going to be an upgrade to growth.
So you have this huge stimulus from the government.
Surely there's going to be demand side inflation too.
We're moving towards normalization.
Which makes people nervous. What does the Fed do with their expectation for the first rate hike?
The focus right now is this unfolding growth surprise.
This is a test to the Fed's credibility.
Let's bring in the Bloomberg team, Michael McKee and Abigail Doolittle. Morning, Mike.
Good morning, John. I think it's going to be a test of the Fed's credibility this week. Everybody focused on the U.S. Central Bank and what it's going to do and whether or not it can hold to the idea that unemployment is more important than inflation. Inflation driving a whole host of central banks as they meet this week, but from different directions. You start with Romania. Romania is meeting today, and they have higher than expected inflation. They thought the central bank might cut rates, but maybe not because of that. Tomorrow you get Sweden. It's not a decision, but Central Bank Governor Stefan Umges goes before the parliament because they had low inflation, too low inflation, and now people are saying maybe they cut rates again, negative rates in Sweden. Then we get to the Fed, and of course that's going to be the driver for the week. Hold on to that thought for a second. On Thursday, the Bank of England, and the question is not whether they're going to move monetary policy. They're expected to keep it the same, but do they stick with a plan to slow the asset purchase program, given the fact that the economy contracted the most in, well, 3 centuries? That's kind of a figure to look at. The Norwegians expected to leave rates unchanged at 0, but they're going to be also watched for when they bring forward, or if they bring forward, their rate increase. Bank of Japan, this is going to be an interesting one. They are going to be talking, John, about the idea that you could release a study on what would happen if you cut the negative rate even further without cutting the negative rate. Does that send a strong enough signal? And in the U.S., we are going to be looking at the dot plot. No change in the purchase program, but do they pull forward their tightening as well? The market thinks so.
If they revise those forecasts higher, Mike, question is, should they? Should they bring that dot plot forward?
Well, it's a misunderstood thing, the dot plot, because the participants all put their numbers in before the meeting. So they think it's basically, what do we think it's going to happen, what each individual person thinks is going to happen. But you can see there on the chart, there is an expectation that they will raise rates in 2023. So we'll see if they bring that forward from the long-run forecast.
Mike, thank you. Full coverage in the days ahead on all these central bank decisions we've got coming up. On the price action, here's Abby.
John, if we take a look at the 10-year yield, it's really pretty incredible this year. Extraordinary action right now on the session, whipsawing right around even. But on the year, an incredible backup right now at year highs, gaining 70 basis points this year, the most on record on an annual basis, and it's only March. So it's probably pretty safe to say this is a historic record-breaking year for yields. The big question, though, is it healthy reflation, which is stimulated by policy changes on the part of the government, or is it scarier inflation? If we go into the Bloomberg terminal and take a look at the chart of the Bloomberg Dollar Index and the 10-year yield, we're going to see over the last month, they've been pretty much climbing alongside. This probably supports reflation, John, because if it was inflation, you'd have that dollar going down on fears that it would become worth less. Think the peso and other cases of really hyperinflation. We certainly don't have that. However, relative to inflation, if we take a look at break-evens, 5, 10, and 30 break-evens are on the rise in a big way this year, John, and that, of course, may support some idea of inflation, but Fed officials and other officials, of course, linked to the Biden administration saying that inflation is not an issue, and if it does pop up, they have the tools to deal with it.
Abby, thank you. That's the story right now. We'll talk about those comments from Secretary Yellen in just a moment. Let's look at the forecast coming out of Goldman over the last couple of days. Looking for GDP to maybe have an 8-handle quarter on quarter in the fourth quarter, and for unemployment to come all the way in from where it is now to maybe as low as 4% year end and then 3.5% next year. And I think the really important part of this call from Goldman is blowout growth, unemployment plunging, but PCE inflation remaining really quite steady, just 2.1% in 2023. So that's the outlook from Goldman Sachs. We'll have much more on that in just a moment. Let's turn back to Secretary Janet Yellen dismissing inflation concerns during an interview with ABC.
Is there a risk of inflation? I think there's a small risk, and I think it's manageable. I don't think it's a significant risk, and if it materializes, we'll certainly monitor for it, but we have tools to address it.
Let's bring in HSBC Steve Major, staying up late into the evening in Hong Kong for us. Steve, always great to catch up with you, sir, and thank you for staying up late for us. Let's just start with it. When Secretary Yellen says we have the tools, is she talking about the Treasury or her old establishment, the Fed?
Well, that's quite mischievous of you, isn't it? You're being quite naughty, John. So, well, it's both, isn't it? And the policies of the Fed and Treasury have always been interlinked, and it's foolish to think that they're separate. So the Fed knows what the Treasury is going to do, and the Treasury knows what the Fed's portfolio of bonds looks like, and the two work together. So it's very, very easy if they want to start to manipulate the term structure, and there are very subtle shifts and hints that they can make before they do anything as drastic as Japan or Australia. So yes, she is right, and so is Jerome Powell. They have the tools if they need them.
Well, let's talk about whether they need them right now, going into Wednesday, Steve. Do you think they do?
Well, they don't want to be panicking, and one year ago, I wrote a paper with a colleague of mine, Larry Dyer, about yield curve control, and we said at the time that yields were too low for them to want to cap. So historically, you're going back to the 50s, they used a 2% nominal number. And of course, yields are much closer to that today than they were 1 year ago. So the point is, with any kind of intervention, to make it credible, you've got to be prepared to stand up and defend it, like Australia did with the 3-year. So they're probably watching this at the Fed very, very closely. I don't think that they want to start a fight with the market, and they don't want to take a fight that they're going to lose either. At the moment, they're probably quite happy that AIT has been delivered for them by the market, probably ahead of schedule. The question now is how to calm things down a bit.
Well, let's talk about that now. Do you think they're concerned about the level of nominal yield, Steve, or the amount of volatility that we've seen? What would be on your radar if you're on the FOMC right now, given these huge intraday trading ranges we've seen, Friday as an example, over the last month or so?
Well, compared to what we saw last March, it's still nothing, isn't it? The dysfunction that involved the Fed stepping in and buying an annualized equivalent of $30 trillion in the first month was something which is unprecedented. I mean, that they were buying on an annualized basis more than the entire stock. So now they're just buying this 120 a month, 120 billion. It's quite steady. So the dysfunction and the volatility and the illiquidity people speak of, it's nothing compared to back then. They will be watching. I mean, there are so many factors at this point. As you know, at the end of the month, there has to be something on the SLR, on the supplementary lending ratio. It's all interlinked: regulation, Treasury, Fed, market, economy. It's all coming together. So I don't think they're in a rush to do anything, and I think they're probably fairly happy that the AIT is up and running.
Well, Steve, let's talk about what's been driving the move. As you know, more recently it's been a move in real yields, but the general conversation around markets, whenever yields are higher, is this reflationary story and the inflation component of it. Steve, something you've pushed back on, and I think it's quite compelling to me and probably to others too. We often look at the market and we take the 10-year nominal and we'll break it down in really fancy ways and say, this is the real yield piece, this is the inflation expectations and all the rest of it. Steve, how easy is it to do that, and how much more nuanced is it actually?
Well, there is a lot of nonsense spoken about this. I think economists would like to think that real yield equates to real GDP, and inflation expectations equate to the inflation we're going to get. Of course, there's risk premia around both of them, and there's liquidity premia. At the front end of the curve, if the policy rate, the nominal policy rate, is close to zero, and it's trapped at zero by the guidance, if inflation expectations and risk premia rise, real yield can only go down. And that's what happened, down to -2. So it's a nonsense to talk about the real yield like it means something. It's just an outcome. It's even a residual from an equation. It's irrelevant. Further out the curve, it's a bit more solid. As you go to the 30 years, it's interesting that we've seen the real yields dragged higher. But I think that happened once the break-evens went north of 2%, because if you've got 2% break-evens and the Fed's got an average inflation target of 2% over 30 years, approximately CPI versus PCE basis there. But the point is, it's done. So if the nominal yield is rising, real yield can only go up. Now, this says to me there's a lot of nonsense about real yields, and so I think that at a time in the last month or so when everyone's talking about 1970s inflation, everyone's out there with their new piece. Actually, the explanation for the higher nominal yields is the uncertainty around the real yield piece. I think, whoa, what's going on here? People are over-analyzing it. It's a correction from an over-leveraged position, and there's a few questions about the outlook for policy. It doesn't mean to say we're on the verge of a surge in inflation. If we are, where is it exactly? Because I don't see it in the prints.
So final one for me, Steve, to you, just to jump in, because I think the way you framed this through the cycle is important. You've got this short-term cyclical story we've all got to work through the next couple of months, and then you've got the longer-term secular headwinds to Treasury yields. Can you just walk me through that tug of war, Steve, and why that's still the appropriate way to think about this bond market in America?
Yeah, what matters for bonds is the level of debt, the debt servicing channel, the demographic position, technology, wealth inequality, and global factors, really. They all drive the low for longer. I respect, I understand there is a near-term narrative. There has been a huge fiscal shock, which we didn't see coming in terms of the size. But this has happened to me 3 times in the last 10 years, and forwards have moved about this much. Perhaps we are on the verge of a new paradigm. Perhaps everything is about to change. But I would suggest think very carefully before you start calling for higher and higher rates. Those people that are forecasting 2% should know it's in the forwards. It's already in the price. So if you're going to forecast 3%, then that's a real forecast. But most people who are calling 2, they're just forecasting what's in the price already. So I think everyone needs to calm down. I think we'll have a consolidation phase and yields will be back down and lower again by the end of this year.
And I look forward to catching up before the end of this year. Steve, it's good to see you. Great to catch up. Steve Major of HSBC. Coming up on this program, President Biden said to be planning the country's first major tax hike in over 25 years. That conversation up next with John Hancock's Matt Miskin. Counting it down to the opening bell, 17 minutes away in America, in New York, equity futures look a little something like this, up 2 points, and we add the smallest bit of weight to all-time highs on the S&P 500. From New York City this morning, counting you down to the Fed on Wednesday, this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The Fed decides. As investors challenge the Fed's view on inflation, how will policymakers react? Coverage begins at 2 p.m. Wall Street time on Bloomberg Television.
Billionaires that was put forth the other week from Senator Elizabeth Warren. That wealth tax is something that is really going to ignite a debate amongst Democrats, particularly as progressives look to move President Biden back to the left following the compromise that he made with centrists during the last round of stimulus negotiations. But let's take a look at what the administration has let leak out with regards to some proposals for what they are looking to be a framework for the tax proposal. First and foremost, to repeal parts of that Republican 2017 Trump tax cuts, to raise some of the corporate tax rate back to 28%. Republicans are not going to like that on the banking committee. They feel that a lower corporate tax rate would help to drive some foreign investment back to the United States. And then increasing income tax on those earning more than $400,000 annually. Either way, it's hard to see how this would actually get through with any Republican support. And because of that, it's increasingly unlikely that in the immediate short term they would be able to get this through. Jonathan?
This is where the conversation is, though, right now. Kevin, it's good to see you, sir. As always, Kevin's already there down in Washington. Let's bring in John Hancock's Matt Miskin now for a little bit more. Matt, this has always been about the aggregate stimulus that we would get down in Washington, and now we start to talk about redistribution just a little bit more. As a market participant, how do you process that?
Things are awesome right now. You got to take advantage of it, John. But as we look at the end of 2021 and into 2022, there are headwinds. So whether it's higher taxes, the Fed potentially tightening or at least tapering QE, and China's credit impulse rolling over, potentially slowing global growth in the second half, now's a great time. But as we look out into the next 12 to 18 months, there are things that could halt the earnings growth prospects and cause a bit more choppiness for these markets.
Before we we get a little bit more of that this morning from JP Morgan, the team led by Jay Barry looking for almost 2%, 195, I believe, on 10s year end. Do you sense we've had that moment yet where we've capitulated on a better view a year out, and then we start to think about from then, what does 22 look like? What does 23 look like?
Yes, we're broadly seeing that the consensus forecast is getting jacked up on economic growth this year. So we've gone from about 4% consensus estimate. We believe that ends up about 8% after this $1.9 trillion stimulus bill. But a lot of this is short-term stimulus. So this is going to pump consumer capital into the economy short-term. It's going to be awesome. But then as we go into 2022, we've got to pay for that. And so you've got to look at the cyclicality now. The yield curve is steepening. Play the cyclicals. Industrials are our favorite idea on that. But we could be into longer duration, higher quality assets within 3 to 6 months again.
3 to 6 months.
Because we're looking at, yeah, so if the yield curve steepens here to, let's say, 200, 300 basis points on the 210 spread, that's about as good as it gets. And then we'll likely be in flattening mode all over again. And that's when you want to go back into growth, back into higher quality, longer duration assets. And so don't totally write that off during this value rally.
One thing you and Emily Rowland have sort of joined in on over the last couple of weeks on this program, man, I do think it's important, is you've not called it a global synchronized growth story. You've talked about that dispersion, the variation we get between different places, different countries, different regions. And I think this week's just a perfect example of it. We could get rate hikes over the next couple of weeks, next couple of months from Turkey, Brazil, Russia. At the same time, we're going to see boom times in America and a Fed that says, no, thank you. We don't want any piece of this. We want to hang back. Matt, how do you want to play that right now? It's a story that's become increasingly really well known in the last couple of months. How well priced is it?
Well, we still think it has further room to run. So, you're talking 8% GDP growth out of the United States potentially this year. That'll probably be of the best growth we see in our lifetimes. So the U.S. is going to be really one of the powerful global growth engines, and we want to be tilted to the U.S. with cyclicality in the U.S. to benefit that. The yield curve is going to be able to steepen in the U.S. We cannot necessarily say that for Europe or Japan or many other developed international or global countries. The ECB is already pushing back on the curve steepening. The BOJ wants nothing to do with a steeper yield curve. If it's going to just steepen in the U.S., cyclicality will pay off in the U.S., and that's what we want to be positioned for.
That's the equity side, Matt. How do you want to push it through the FX channel?
So we do think the dollar eventually wakes up to this. So the dollar has been steamrolled over the last 6 to 12 months, but higher interest rates here, better growth. We think relative growth differentials eventually pay off for a stronger dollar. It's been weighed on by the stimulus package. I think a lot of it, global investors didn't want to get ahead of that before the stimulus package. But if the growth materializes, as if we get 8% GDP growth, we think that results in capital flowing to the U.S. That means a stronger dollar. We're out of that dollar, the weaker dollar camp. We believe it strengthens here in the next 6 to 12 months.
Matt, it's good to see you, as always. Next time we'll talk a little bit more about the China call, because I think for the global cycle, it's absolutely pivotal, given how much we've seen in the commodity price action through this year so far. Coming up on this program, I'm pleased to say we'll bring you some analyst action you need to know. That'll be next in our morning calls. And then later, Americans receiving their fresh stimulus checks, potentially setting the stage for another wave of retail trading madness. That conversation still ahead with UBS's Stuart Kaiser and Jana Barton of Eden Vance. From New York City this morning, good morning. Counting you down to the cash open. Equity futures on the S&P 500 up by just a couple of points after we close at all-time highs in Friday's session. Can we advance just a little bit of the opening bell? That's 7 minutes away. This is Bloomberg.
Not only just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. Having the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
We're thankful to be able to come to a place like this and be able to break some stuff and release some tension without going to jail.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
All the things, all around you, where you learn, work, and fly. We help make them healthier. We are the people of ABM. For more than 100 years, we've been a leader in making spaces cleaner, from the things you touch to the air you breathe. Today, more than 100,000 of us are innovating to ensure spaces are more efficient, healthier, and safer. ABM, making spaces healthier for you.
My music is powered by the latest technology. To get the crowd going in the club, or in my Jaguar playing the track for the first time. It's always one touch away from an amazing experience. New F-Pace, how Jaguar makes an SUV.
For great offers, visit your Jaguar retailer during the Impeccable Timing sales event.
In boxing, or any other business, one day, you're gonna take a hit you didn't see coming. Do you stay down, or do you get up?
And this fight is a long way from over. Leonard is coming back.
ButcherBox members. We're multitaskers. We choose the highest quality meat to feed our families. We know time is precious, and we love saving it. We take care of the environment, and we support farmers who do things the right way, all while cooking a mean ribeye. When you choose ButcherBox, you're choosing to make a difference.
When we started our business, we were paying like an arm and a leg for the postage. I remember setting up ShipStation. I think it was just like 1 or 2 clicks. Everything was up and running. I was printing out labels and saving money.
ShipStation saves us so much time. It makes it really easy and seamless. Pick an order, print everything you need, slap the label onto the box, and it's ready to go.
Our cost for shipping, like, we're cut in half, just like that.
ShipStation, the #1 choice of online sellers. Go to shipstation.com/now and get 2 months free.
25 seconds away from the opening bell in New York City this Monday morning. Good morning to you all. Equity futures on the S&P 500 slightly positive. On the S&P up by 2 or 3 points. On a Russell slightly negative, down 0.2. Your relative outperformance from the Nasdaq up by about 16 points and a little more than 0.1%. There's the opening bell. Switch up the board into the bond market ahead of the Chairman Powell news conference on Wednesday and a Fed decision. The focus on the forecast. The yields come in about a basis point to 161.43 on 10s. In foreign exchange, the dollar slightly stronger, euro weaker, euro dollar 119.22 and down around about 1/3%. And crude takes some weight off WTI, down a little more than 1%, $64 and about 90 cents. That's the cross-asset story at the market desk with your movers. Here's Abby.
John, futures may be basically mixed and slightly higher, a little bit of a risk-on mood, but where we have a bigger risk-on mood, the reopening trade. If we take a look at airlines and other travel-related stocks, we are going to see lots of green. Delta, at a recent JP Morgan online conference, did say that the travel improvement is real, substantive. They're also, despite the fact that their revenues are at the lower end, it seems that investors like the fact that they are maintaining guidance. That's clearly a good thing. Carnival also higher. And then take a look at AMC Entertainment popping up 6.8%. They have plans to open all 56 theaters in California by March 19th, including 2 flagship theaters in LA. And then rounding out this reopening trade, we have Caesars Entertainment popping also on the travel tailwinds, but they are being added. That stock is being added to the S&P 500. It's not just reopening, though. We have a small reflationary bid as well, even as yields are trading mixed. Take a look at the big banks. Some green on the screen. This, of course, as you know, is the story of the year. As yields climb, banks are climbing. We have a little bit of that today. And finally, the defensive trade, last year's defensive trade, it seems more going back toward the growth side at this point. Big tech is also higher, although Palantir has flipped lower, but Apple, AMD, both higher. Although, John, you can see that red for Palantir. That stock had been up 2% just a few minutes ago. So keep an eye on tech. Perhaps we're going to see that sector under pressure again, and that means, of course, watch yields.
Abby, thank you. It's a marginal move higher on the S&P 500. 2 minutes into the session on the Nasdaq. Dead flat. The story going forward, the stimulus checks are rolling out. Where does the money go? The Mizuho team have done the survey. Here's the quote. 2 out of every 5 stimulus recipients surveyed expect to invest some portion of their checks in Bitcoin and stocks. Overall, 10% of total gross stimulus checks, or roughly $40 billion, may be allocated to Bitcoin and or stock purchases. For more, here's Kaylee Lyons.
Hey, John. Well, more retail money could be heading full force toward this market. Mizuho surveyed more than 200 people who expect to receive those $1,400 checks, and they expect the bulk of that money that people plan to invest is actually going to go to Bitcoin. About 60% of the incremental spend is their estimate. That would equate to about $24 billion. The other $16 billion they expect to go to stocks. Now, granted, 64% of those surveyed said they will not be putting money into the market, instead putting it toward bills or savings, what you would assume is actually the intention of the aid spending. But 21% of people expect to invest up to 20% of their funds, and smaller portions expect to invest more than that, actually 2% saying they put 61% or more into the market. Again, with that spending, Mizuho expects Bitcoin to be the more popular investment choice, estimating it could add as much as 2 to 3% to Bitcoin's current market value, which as it stands is more than $1 trillion. And when we look back at the market performance after the prior 2 rounds of stimulus checks, Bitcoin did go up. After the first 1,200 payments went out on April 14th last year, Bitcoin rallied about 37% over the next month. And after the $600 payments at the end of December, it rose 28%. So there may be a stimulus effect at play there. That wasn't really evident in the broader market. It only rose about 3% after the first round of payments and actually was slightly down in the month after the payments in December. But even if it's not true at the index level, we know that stimulus payments may have had a big role to play in some individual equities like the likes of the Reddit trader favorites, GameStop being one example, John.
Kelly, thank you. Thank you very much. We, of course, want to be really careful with this. We know for many people right now who are struggling, this money is real relief. We also know anecdotally, though, from the people you talk to who receive these checks, where some of this money has gone. It's not just gone to pay off debt. Some of it has gone into the stock market. Some of it has gone into Bitcoin. To what degree, I don't know. And this is a survey of just 200 people. Let's have the conversation about retail trading. We can do that now with Jana Barton of Eden Vance. We can do it with Stuart Kaiser of UBS. Jana, let's start right there. Just how powerful you think the incremental US retail buying actually is?
Well, it certainly moves the market, but I think a more powerful story is the return of an average stock. I think last year it was all about cap-weighted, bigger cap names doing well, and year to date it's been a complete inverse of that. The S&P 500 is up about 5 percentage points, but more importantly, the average stock in the S&P 500 is up over 11 percentage points, which I think kind of bodes well if you want to be an active stock picker. This is the time to do so.
Retail has been super active. Stuart, they've also been super active in the options market with short-dated call options, and I'm trying to assess the outweighted impact retail buying can actually have on a broader market, Stu. What's your read on that?
Good morning, John. Honestly, hopefully, I hope the stimulus checks have very little impact on the equity market. I think all of us would like to see that stuff get spent and kind of invested in the economic recovery. In terms of the impact on options, I think we've seen two very clear cases when that's happened. September of last year, with that kind of tech rally, and then Nasdaq sell-off, and then with the retail-driven stuff in January. So, I would agree. I think on smaller stocks and over tactical periods, it can be very, very impactful on a relatively small sort of pocket of the market. But I think big picture, that type of stuff isn't necessarily what's going to drive the market higher. Our view is what's going to drive the market higher is improving employment, spending on consumer services, earnings growth, et cetera. So I think in that sense, if it's real money getting invested in the market through actual cash ownership as opposed to kind of short-term tactical trading and options, I would read that as a much more healthy way for retail to be invested in the market.
We've seen the huge rotation, and Yana, you took us straight to your main talking point, was the performance of the average stock is doing tremendously well. Do you think for investors right now it's better just to sit in the S&P 500 equal weight, or to actually be as active as you're suggesting?
I think active is the name of the game. Again, I think the biggest risk right now is to seek equity exposure in a passive way because you're not getting the performance or valuation spread. Again, going back to what are the data points you're watching to be active and how active should you be? A couple of data points for your viewers. The cross-sectional and standard deviation of returns, meaning the spread between the best and the worst, is right now at 3 standard deviations above the mean. That means we haven't been here in over 10 years. That means that if you pick your spots, you can do really well and significantly better than an average cap-weighted name. A second thing is co-movement in the market. Again, the correlation levels that we've seen, particularly in the growthier areas of the market, are heading lower. Again, you want to be active in picking your spots. And I totally agree with our colleague here is that it will be all about earnings growth. Over the short term, it is all about sentiment and kind of the momentum trade catching that bid where the action is the greatest. But we're dealing with a market that's over 30 trillion in size. There's a lot of opportunity for investors to seek that exposure in more than just one or two areas of the market.
Stu, speaking of that earnings growth that Jana's alluding to, this is a well-known story now. The data in the next several months is going to boom. Do you still think that's underappreciated?
Yeah, I do. I do think the degree of earnings growth we're going to get is a little underappreciated. And I think there's also a wide range of forecasts out there, which I think suggests that people aren't necessarily certain on the size or the timing of that earnings growth. So, yeah, I do. I think it's a bit underappreciated. I think as the GDP growth and the earnings growth and the drop in the unemployment rate begins to materialize, that that's going to be extremely positive. I mean, if I told you the U.S. economy was going to grow 6 to 8% this year and then 4 to 6% next year, I think generally you'd want to own equities in that environment, and I think that's our bias at this point.
I'd be very excited about the 6 in 22, that's for sure, Stu, if you told me that. Stuart Kaiser's going to stick with us. Jana Barden. Jana, thank you. Thank you for being with us. Your time's important to us. Thank you very much. Let's turn back to this market, about 8-9 minutes into the session with your movers. Here's Kriti Gupta.
Well, good morning, John. You are seeing that travel outperformance spill into the U.S. session after seeing that really be the story in Asia and Europe. Let's just take a look at some of these stocks. United Airlines and Delta Airlines both in the green. You can really see those massive gains. Carnival Cruise Lines as well, trading in sympathy. When you have those airlines go up, cruise lines tend to follow. Most volatile stocks in the S&P 500 also trading in sympathy with Boeing. Very positive TSA rebound data coming out of the U.S. as well. If you also look at some of the entertainment names, once again, you have have from a macro point of view, that rotation trade. But look, AMC Entertainment announcing that they're preparing to resume operations at almost all California locations. And for perspective, John, LA alone is a bigger market for this company than New York. So it really tells you that this is a major boost for that stock. Penn National Gaming also entering the S&P 500, so investors hopping in on anticipation of next week. And lastly, Extended Stay America really gaining after really outperforming during the pandemic, earning itself a buyout from Blackstone and Starwood Capital. John, get this, for a whopping $6 billion.
Pretty big numbers. Thank you. Pretty mentioning the travel sector. Southwest out with a headline this morning that really underlines, underscores, emphasizes how bad things were last year and how much things are improving relative to last year. May 2021 capacity to increase 118% year on year. Maybe telling you more about how bad things have been and not how good things are right now, but they will be getting better in the view of many of these airlines. Coming up, AstraZeneca's vaccine delays, delivering another blow to a slowing European recovery, and why Ireland, the Netherlands, and countries across Europe are lining up to suspend shots of this particular brand. That conversation up next with Stuart Kaiser at UBS. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Only only 11 doses have been given per 100 people. And actually in the Netherlands, which just halted the Astra shot, it's among the lowest, only about 7.6 doses per 100, a number that pales in comparison to the 32 and 39 per 100 in the US and UK, respectively. Now, according to Bloomberg's vaccine tracker, at the current rate, it would take about 16 months for 75% of the European Union to be covered with a 2-dose vaccine. Compare that with 5 months for the US and 7 months for the UK. The point of the story is the block is behind the curve. All that said, globally, more than 359 million doses have been administered. The latest rate is up to 9.25 million per day. It is ramping up as more vaccines come onto the market. But even at that accelerated rate, John, it would still take years to have enough people vaccinated to reach global herd immunity. So the road ahead is still quite long, John.
Really long road ahead and a tough one for Europe and emerging markets, developing countries much more so. Kelly, thank you. Stuart Kaiser at UBS expecting Europe to follow suit in the value rotation. He writes the following: the US value trade has benefited from rising inflation expectations, and we expect a similar pattern in Europe if break-evens rise as the economy reopens. Stuart is back with us. Stuart, let's try and navigate this together, because this is a tough moment for Europe, but it's such a well-known story right now, and I'm trying to understand whether the negativity, the pessimism, has already been priced. What's your take, Stu?
I mean, I think that the negativity is pretty evident, just in the sense that the European markets have underperformed the U.S., and I think they've also underperformed where you would have expected them to be based on risk sentiment and the performance of value factors and things of that nature. So those markets have, I mean, they've underperformed probably for 10 years, but I think tactically speaking, they've kind of lagged this value rally that we saw in the U.S. starting around Election Day, and that's what's caught people's attention. I think some people are viewing this as a natural chronological progression, and eventually Europe is going to get themselves vaccinated, the economy is going to reopen, and those markets should respond sort of similarly to the way the U.S. did. And I think that's why we've seen so much interest there, because if you look at what's happened to a small cap in the U.S., for instance, you know, that stuff's been sort of hard to buy because it's rallied so much. So, you know, people look over to Europe and they see something like the DAX that is, you know, heavily in industrials and materials and a very cyclical market that has underperformed its global risk exposures, and they think that that's the next leg of the trade, and we've seen a lot of interest for that reason.
The DAX at a record high, but granted only up 5% so far this year, Stu, compared to what we've seen on the Russell, which is closer to 20. But when I look at the financials over in Europe, we're up 19% on the year so far, Stuart. Granted, below where the regionals are in America and the performance of the S&P 500 banks, Stu, but it's hard for me to sit here and say we haven't had much of a rotation in Europe. Where are the opportunities, do you think, on the continent?
Look, you know, financials is certainly an area a lot of people have focused on. You know, European financials have been a really hard trade for a number of years now. So, you know, we've honestly tried to keep things pretty simple from our perspective, and that is, you know, find the markets that have the very cyclical sector mix that you want, and just do it in, I guess, you know, more of a blunt force way that way. So, you know, I think DAX is one that we like. The periphery markets, you know, so let's call that, you know, Spain and Italy have obviously been very volatile, and I think some people are trying to play that game and assume that they're the next step out the risk spectrum, and potentially put that exposure on as well. But I think from our perspective, it stays sort of broad-based at the index level and execute it that way, whether that's Euro stocks or DAX or things of that nature. So, you know, I understand the allure of the travel stocks and the lodging stocks and things like that. And I think in the U.S., that's been much more necessary because the indexes themselves have rallied so much that you've kind of had the value pick below the index level. I don't think that's as much the case in Europe, and I think we're still at the stage in Europe where you can just focus on the index level and be pretty happy with the returns you're going to get.
European travel on the year up by more than 20%, record high there. Stuart, just a final one then, putting all this together, are you comfortable being overweight the DAX or long the DAX relative to the S&P 500 for the remainder of this year?
For the remainder of the year, I'd say probably not, Jonathan. The main reason being, you know, the vaccination rates in the U.S., the amount of stimulus in the U.S., it kind of feels like you might get another period of U.S. exceptionalism as the year progresses, and people seeing kind of growth rates evolving in the U.S. that just can't be matched in other parts of the world. So I think, you know, as you're in the early stages of that reopening, I think there is a trade to be had there in terms of being long DAX and being long Europe. If you ask me over the next 6 to 12 months, you know, I have less conviction in that.
Stu, always good to see you, sir. Stuart Kaiser there of UBS on a situation in Europe right now. It's a situation that I've really struggled to reconcile over the last couple of months. And I go back to that performance on the European banks. The banks are up 19%. Yet when we saw a lift in yields over in Europe, we had the central bankers pushing back and saying it wasn't consistent with the outlook. So is the move in banks of 19% consistent with the outlook? Is this just the reopening rotation? And do we have to question how durable it is? Because I've had a lot of people talk to us through the morning, including Jay Poloski at TVW, who actually want to stick with this trade, stick with it beyond just the 20% move, stick with it through the cycle. More to come on that as the week progresses, as we look to the Federal Reserve and a set of forecasts that come out of the Fed that will be night and day with what we saw from Europe just 6 days prior to that. That's the story for this market and broadly the transatlantic story. Let's get you some sector price action. Here's Abby.
John, not surprisingly, with the major averages fluctuating at this point, small declines currently. We're looking at neutral sector composition. If we go into the Bloomberg terminal and use the IMAP, we'll see a little bit more green than red. But up top, you have true defense. Utilities up 0.9%. This is yields actually dropped just slightly, so those dividends look a little bit more attractive than staples, industrials. On bottom, we have the reflationary sectors, financials and energy, and actually at this point down pretty substantially, John. Financials down 0.9%, energy down 1.3%. So it seems as though the reflation trade today, at least, is mainly on hold. On the year, though, it's an opposite picture. We've been looking at this board quite a bit, but it's because it is so extraordinary. On the year, energy is up about 37%, heading to its best year ever on record since 1990. And as you were mentioning, banks up in a big way, up more than 15%. On bottom, the only two down sectors are today's two top sectors, utilities and staples, and that has everything to do with that huge backup in yields, making those dividend-rich sectors look a lot less attractive, John.
Abby, thank you. Thank you very much. Travel, a big story through much of this morning. Talked about Europe just briefly there. Let's talk about the United States and United Airlines. The CEO, Scott Kirby, saying he sees a full recovery in business and international travel demand. But here's the bigger issue. He offers no timing for that recovery. Some comments from the United Airlines CEO in just the last couple of moments. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary as we continue to count you down to a Federal Reserve decision just a couple of days away. Let's touch on the price action. Before we get there, we look like this in the equity market. Your S&P 500 unchanged, dead flat. Your NASDAQ positive by 0.1%. It's all been about the bond market in the last couple of months. If you switch up the board and get to treasuries, on Friday, your intraday high was 164. Right now, 160.90 and coming in a basis point or two. Though as many people have discussed, and including someone I really trust in the bond market, just look at the ranges and pay attention to that. The intraday price action has been really, really volatile. 153 the low last Friday, 164 the high. A simple question, on what? What was driving that? Nothing in this market really to get your hands around. It's just been really, really volatile. Is that something the Fed needs to think about more? The volatility in a market as liquid, or supposedly as liquid, as the Treasury market. There 10s for you at 160.90. There's the euro at 119.25. And the question of the morning for me, there's two of them. Okay, how well known is this story, this transatlantic divide? How well priced is this story? That's what matters to markets. From New York City this morning, good morning. Much more still to come. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Countdown to the open. This is Bloomberg.
My son needs this drug. I hope it doesn't cost too much. I hope my insurance pays for it. Can you tell me how much this will be?
67.
Sorry.
Wait, have you heard about GoodRx? GoodRx finds free coupons to help you save up to 80% on your prescriptions.
Wow. I had no idea.
GoodRx. Stop paying too much for your prescriptions.
It's a wish list on wheels. A choice that requires no explanation. It's where safe and daring seamlessly intersect. It's understated, yet over-delivers. It is truly the Mercedes-Benz of sports sedans. Lease the 2021 C300 sedan for just $449 a month at your local Mercedes-Benz dealer.
We're not as far from our goals as it may appear. Because things are coming back. Making now the time to move forward. At US Bank, our goal is getting you to where you really want to be. Because side by side, there's no telling how far you'll go. US Bank, we'll get there together.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you can become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
What can you expect from ButcherBox? 100% grass-fed beef, organic free-range chicken, heritage breed pork, and so much more. From farmers who believe in raising animals with care, with no antibiotics or added hormones, ever. All with free shipping right to your door. Together, we can make a difference, one meal at a time. Visit butcherbox.com today to get free ground beef for the life of your membership.
See yourself
Welcome back to the mirror.
and know you're not alone, because this is not just a mirror. It's an unstoppable community.
Come on, Jesse, one more.
It's every workout
Come on, you two. Let's go.
for everyone. So join in now and see your best self in the mirror.
Monday, the
15th of March, 2 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alex Steele is over in New York. Alex, I have to reinforce those times because you decided to move an hour closer to me.
I did, which is really, quite frankly, let's be honest, complete torture for parents who have kids because the kids are a hot mess. It was 2 hours crying about the zoo yesterday, Guy.
Well, that's certainly something you don't want. And having to get up an hour earlier, that's going to hurt as well. So spring forward, it's going to make things a little messy. But it's nice to have you just 4 hours away rather than 5 hours away.
We're just so much closer. All right, let's check in on the markets here because yield's still driving the story, but everything seems to be taking a little bit of a break. You have the Russell 2000 kind of sitting on those record highs, Guy. You have yield still, sitting around 1.6%, all ahead of that Fed. That's going to really be the key marker. Where yields go will really determine where other areas of the markets go as well, Guy.
Absolutely. Let's talk a little bit about what is happening with these markets in particular. Let's reference what is going on with the 10-year because we're trading what, as Alex says now, 1606, 160, basically a huge move up over the last few months. We're trying to figure out exactly why. Technicals, one of the big features around that. If we get through some key levels here, what are we going to see this week? Katie Stockton, Fairlead Strategies founder, is here to answer some of those questions. Katie, great to have you on the show. Thanks for your time today. Look, we're trying to figure out where this 10-year is going. A lot of people are pushing it up towards 2%. The question is what gets us there and how are we set up going into that move? Technically, what does the 10-year look like right now?
Well, it's been a very, very strong move in terms of momentum from a short-term perspective, and the 10-year yields have already cleared several resistance levels. The last one that was cleared is about 1.38%, and that was a former support level left over from 2012. So I think it's helpful with the Treasury yields to take a very long-term view. If you look over the last 25 years, it's very obviously a downtrend. Still within the context of that downtrend, the very steep up move that we've seen tends to be indicative more of a counter trend move. The kind of move that would look more sustainable over the very long term would be something that was a bit more gradual than what we've seen. So we're expecting the steep up move in Treasury yields to give way to a consolidation phase. They do tend to have this sort of, characteristic where they stair step, where you get the steep up moves and then they're followed by a consolidation phase. So that's what we're looking for here. But the breakouts that we've seen already target about 2.1% within the framework of that multi-decade downtrend channel.
Katie, what we learned last week was that you're still having treasuries and tech move together. You get a sell-off in treasury market, you get a sell-off in tech. So if we get to that 2.1%, I'm wondering what that does to the NASDAQ 100 because it looks like that chart's really compressing between the 50 and the 100 day.
Right, so we've already seen a pullback develop that reflects a loss of not only short-term momentum behind the NASDAQ 100, but certainly a loss of intermediate-term momentum that really isn't evident in Treasury yields yet. So the pullback that we have seen in the NASDAQ 100 came into some support around 12,200. That level has held to date, leading in part, I think, to last week's oversold bounce. But the intermediate-term gauges that we track, including measures of overbought, oversold readings, suggest that the pullback has not fully run its course yet. We do not have an intermediate-term oversold reading to give us confidence that that initial support level will hold, that perhaps it gets as bad as secondary support, which is about 1,000 points below that level. So we're assuming that the NASDAQ 100 will remain in a corrective period. It certainly underperformed the S&P 500, not helped by areas like the semiconductor sector. So we're looking for continued underperformance by semiconductor stocks, and that could be a continued drag as well.
Katie, let's talk about internals. As we've watched this huge rotation away from these growth stocks towards the value sector, and it's been a massive move, we've seen an increasing number of 52-week highs. What are the internals telling you about the way this market is going to move next?
Well, this has been widely publicized. We've seen a lot of chatter out there about new 52-week highs on the NYSE. We've gotten to levels that we rarely ever see, quite honestly. And I tend to look at that from a contrarian perspective. The new highs tend to be sort of like a high frequency at certain parts of the market, and this is a very emotionally charged tape. And when it reaches current levels, it actually tends to be an overbought reading, meaning that it's followed by consolidation or corrective price action in the major indices. So short term, it's really not a positive takeaway for the market, but intermediate term, I would say it is, because that expansion in new highs, as you mentioned, does reflect rotation into other sectors outside of technology. So that broadening of the leadership behind the market, I think, is a good intermediate to long-term positive. However, in the short term, that new highs reading is actually quite overbought.
Katie, thanks for setting us up today. Really appreciate it. Kay Stockton of Fairlead Strategies. Let's get back to the 10-year for a second, because we've seen a re-rating higher, and strategists are also following that cue. So the white line is the 10-year bond yield forecast for 2021. The blue line is where we're actually trading for the 10-year. You can see the white line, a big jump up over the last few weeks and what analysts are really expecting to see. However, that could get even higher. Deutsche Bank just today raising their forecast by a full percentage point. You don't see that kind of forecast very often, all the way to 2.25%, all on this vigorous growth and risks of upward pressure on inflation. And that's the quote. Overall, that average year-end target really jumping. Guy?
Absolutely. Everybody's at it. Everybody's upgrading their targets, be it what's going on in the bond market to what is happening in terms of the economic projections. Remember, of course, it is the Fed this week, and we're going to get a summary of economic expectations. The SEP, which is going to be absolutely fantastic in terms of giving us an idea, because the Fed is so far behind as to its current thinking. Goldman Sachs today kind of pushing out its bullish view on the U.S. economy. It's raised its fourth quarter GDP estimate, and this is the year-on-year number for the fourth quarter, to 8%. 8%. Think about that, from where we've come from and where the Fed is right now. Unemployment, which is obviously what the Fed is targeting right now in terms of its focus on the labor market. Unemployment rate may drop to 4% by year-end, 3.5% in 2022, and then 3.2% in 2023. So a significant improvement in terms of the labor market dynamics. What is interesting, though, is they're not seeing much expectations. The Jan Hatzius team really just looking at limited growth of just 2.1% in 2023. But a huge shift in terms of the headline growth rate. Is that also then going to be reflected, do we think, in a significant upgrade in terms of what the Fed is seeing in terms of the SEP, and also clearly in terms of the way we're looking at the dots? Well, let's talk about this. Goldman Sachs' co-head of global FX and interest rates and emerging market strategy, Zach Pandel, joining us now. Zach, the Fed's current projections feel so far out of date. I'm wondering how significant an upgrade we are going to get this week, and then how the market is going to react to that, because Jan Hatzius' team obviously way ahead in terms of what they're expecting.
Well, this is exactly the issue, and I think you're right to emphasize the uncertainty. The Fed's projections at this point are quite stale. They're back from December, and a lot has happened since December. Most importantly, very large fiscal stimulus of the U.S. that has transformed the growth outlook here domestically, and to some extent, more and more information that the vaccination process is working around the world. So the Fed is going to need to make a major growth upgrade at this meeting. And the question is, to what extent does that feed through to the inflation outlook, and to what extent does it feed through the policy rate outlook? And I think really those two things are very uncertain at this point. We've gotten some communication from Fed officials in recent weeks, but it still leaves us guessing on exactly where the dot plot, the inflation forecasts are going to land. And that's going to determine quite a lot for how markets trade over the coming months. The shape of the yield curve, the direction of the dollar, probably are going to depend on what sort of message we get from the Fed on Wednesday.
Right. So, Zach, I guess break that down for us, because the market's so far ahead of the Fed that does the Fed mark to market their expectations with limited volatility? Or if they do that, do we see even a bigger re-rating of the long end?
Our research suggests that if the Fed is moving up the dots, the market's likely to move up as well, even though the market is already trading above where the Fed may end up. So if we get a one additional hike, two hikes in 2023 from the FOMC, we think that that will pass forward into front-end rates, even though the market is already trading above. So that would be a hawkish surprise and likely move the market. Where we go from there is going to depend on a lot of different aspects of the policy message. How long are they going to be doing quantitative easing? And is there any kind of guaranteed minimum timeline? I think that's going to be a key question. And exactly how much inflation do they want to see before they get going? If they show two hikes or one hike in 2023, but also a lot of inflation at that time, 2.2, 2.3% inflation, then that'll be easier for the market to digest. So it's really all three of these things, the QE timeline, number of rate hikes, how much inflation the Fed sees, that's going to determine the market reaction after Wednesday.
Zach, can I just back up a little bit? You mentioned talk there of the front end moving. And I think this is where life gets really interesting. Once we do start to get the front end of the curve starting to react significantly for the Fed, what do you think needs to happen to make that happen? How vigorous do you think the Fed is going to be in terms of its reaction to all of this? You mentioned that it will have some kind of an effect. I'm wondering how big an effect and what impact that will then subsequently have on the dollar.
Yeah, so, anything beyond one additional rate hike in 2023 is probably going to start to move two-year note yields by a meaningful amount. And I would say I would feel even more strongly about that if the Fed gives us no kind of guaranteed timeline whatsoever on the balance sheet. We know the Fed is not going to be raising rates while it's still doing quantitative easing. So the timeline for running purchases at their current pace and then tapering them down helps us determine what can be priced at the front end of the curve. If we don't know that timeline, the market has to put in a risk premium that tapering and rate hikes happen much sooner than expected. And I think you're right to highlight that this is really where the dollar comes in. The dollar has been generally weak for some time because the front end of the curve hasn't really been moving. You've seen a bear steepening of the U.S. curve. That's not a big deal for the dollar. Dollar can generally weaken along those sides of moves. But once the front end starts moving, once we start to price in higher front end yields that that potentially raise the dollar's carry profile to other currencies, it's going to be harder for the dollar to remain weak. So we've had a structurally bearish dollar thesis. I would say we need to go open-minded into this Wednesday's meeting for potentially changing that view. If we get a substantially hawkish message from the Fed, the dollar could change direction for at least a few months here.
Big day Wednesday coming up on Tenterhooks, waiting to see exactly what we get. Zach, thank you very much indeed. Zach Pandel of Goldman Sachs. Right, what have we got coming up for you? We're going to talk more about what is happening with this yields narrative. We're going to discuss it, where investors are going for cheap protection. Amy Wu Silverman of RBC is next. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal time for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Let's
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. There hasn't been a major federal tax hike since 1993, but Bloomberg's learned that President Biden wants to change that. He'll call for higher taxes to pay for a long-term economic recovery program. That plan would include initiatives on infrastructure, climate, and expanded help for poorer Americans. The president would likely try to repeal portions of Donald Trump's tax law that benefited corporations and wealthy individuals. And Republican members of Congress are heading to the U.S. border with Mexico. They want to put a spotlight on a surge of immigrants at the frontier that they say is a result of President Biden's immigration policies. House Republican leader Kevin McCarthy will lead a dozen other lawmakers on a trip today to a detention center in El Paso. And much of China, including the capital of Beijing, was enveloped today in the worst sandstorm in a decade. The storm forced the cancellation of hundreds of flights. Skyscrapers appear to drop from sight amid the dust and sand. Sandstorms used to be much more common in the springtime as sand from western deserts blew eastwards. But massive planting of trees and bushes in fragile areas has reduced the effects of the storms. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks, Ritika. Those pictures were crazy. All right, let's get back to the main story. 10-year yield still on the rise here. How do you play it? Amy Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist, joins us now. We've seen a lot of moves, say, in TLT, which is the long-term ETF. Is there still room to be a bond bear, or are call options going to be less expensive?
Yeah, it's a great question, and I think it comes down always to what's on the horizon, Alex, and what catalysts could potentially drive things further. Obviously, you have the FOMC this week, and then at the end of March, you also have the potential expiry of the SLR exemption. I think this matters a lot to rates volatility, and when it matters to rates volatility, then it moves over to those bond ETFs. Positioning-wise, we've seen a lot of options trade in TLT, but also in HYG, which is a high-yield bond ETF, as well as LQD, which is the corporate version. So, you're seeing those flows to all the bond-related ETFs. And then, frankly, you also see it in QQQs because, as you know, with the rates move, it really impacts kind of the tech-heavy ETFs as well.
Just walk me through how people are positioning for that SLR event. As you say, it's coming up at the end of the month. We don't know yet what's going to happen. It would be quite significant if the banks obviously back away. Just in terms of the kind of the size and the scale of that as an event, what do you think it could look like?
I guess there's obviously many different scenarios, and the concern is the worst case scenario is a really disorderly sell-off. It really depends on how the reopening goes at the same time and if the banks have other places to put that money. And the issue is, we kind of saw an inkling of that a couple weeks ago with a poor 7-year auction. And the concern is if that bond volatility bleeds into equity markets, where does it hit the most? And it usually hits the tech-heavy ETFs. And I always think that's funny to say that, right? Because the reality is the S&P is a tech-heavy ETF. The NASDAQ is a tech-heavy ETF. Like saying tech-heavy is like saying the markets. So, from an options perspective, I find it fascinating that this really isn't being priced in at all. It's a completely flat term structure, guys. Between now and April 16th, you're getting on S&P and Qs kind of 5 times to 8 times payouts to protect against kind of like a down 3 to down 8% move in those expiries. That's pretty high and pretty attractive. And it tells me that at least within equity options, they are not positioning for this to be a volatile event.
And of course, for jargon alert, SLR, supplementary leverage ratio, banks didn't have to count treasuries on their balance sheet and to have collateral against them. So if that moves away and they have to count it back, they're going to have to sell some T-bills in the market, which could create a lot of market volatility. Where else are we positioned here? Like, where else is the market positioned for some big event? And the flip of that question is, where can you trade off of that?
Yeah, I wish I could tell you that people are really positioned here for some big event, and the reality is they're not. They're not really positioned for FOMC this week or even options expiry. You're getting about a 2.5% straddle right now on the Qs. And, that's fairly average versus historical. So, people, again, are not pricing that as momentously. Neither are they doing it for the end of March. I think where you're going to start seeing it, guys, is potentially as we get to the next earnings cycle, maybe you'll start seeing the, the positioning come back. But right now, VIX has kind of come in. We're still floating above 20 handle, which has been, this entire pandemic has been that way. But in terms of the curve, you don't really see a hump in any place special. And then obviously everyone's getting their stimulus checks soon as well, which I think starts to kind of change.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
There's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader.
His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991,